February of this year. Now, a divestment of this kind would follow Banco Sabadell's rival CaixaBank. I spoke with one of our Bloomberg intelligence analysts this morning who told me the sector, well, Spanish banks, they're pretty strong fundamentally. The economy is recovering quickly because of the return to tourism, and there has been progressive balance sheet de-risking over the last few years.
And UK stocks in focus. We just heard from Lizzie Burden, had a conversation about what to expect from this fiscal event today, or a mini budget. Which of the stocks in focus?
Well, specifically retailers, pubs, home builders and utilities. Look, there is a widely expected halt to planned corporation tax rises, and there is room for some short-term positivity for UK stocks. Look, traders bearish on sterling. The FTSE 250 down 21% year to date.
Thanks very much for that, Laura Wright, with the stocks there in focus. The Open is up next. Futures are pointing a little bit higher for Europe, but the US futures picture looks a little more negative, down by around 1/4% on Nasdaq futures. E-mini futures down by 0.2%. The Open for European stocks is up next this Friday. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Welcome to the European market open, everyone. A minute to go until the start of cash equity trading and Francine Lacqua in Rome ahead of the elections on Sunday. Our Tom Mackenzie's in London. Tom.
Good morning, Francine. Here are the top stories then. Markets maelstrom, yields surge, stocks sink, and the dollar batters peers as central banks around the world unleash recession fears. Italy votes. We are live, of course, have you seen, in Rome in what could be an historic election. And fiscal boost. New UK Chancellor Kwasi Kwarteng is set to unveil stimulus plans today. Okay, we're going to check in on the futures. We have Francine, of course, in Rome. She's going to give us the latest in terms of that build-up to those consequential elections in Italy. And, of course, the market's very much focused on what's happening with the spreads, the yields there in Italy, amid arguably greater political risk. The futures then were pointing just modestly higher in Europe, though stateside you're looking at losses, the last time I checked the futures there, of around 0.2%. Of course, the central bank action still being digested from yesterday, the BOE coming in with 50 basis points, the SNB over in Switzerland, 75 basis points, continuing to digest that more hawkish message, of course, from Jay Powell as well. Over in Asia, by the way, worth noting the losses that we've seen there, looking like you're going to get 6 straight weeks of losses across the benchmark in Asia. The Spanish IBEX currently down 0.2%. Over in France, the CAC 40 lower by 12 points or 0.2%. And the FTSE 100 just off by 0.1%. Again, we said in the headlines, looking ahead to that mini budget from the new Chancellor of the Exchequer, Kwasi Kwarteng, tax cuts expected to be central to that as they try to revive the fortunes of the UK economy, with a number of economists, of course, coming out and putting a cautionary note around the potential inflationary impacts of that. Let's have a look at what's happening across assets then. I touched on the futures stateside. And, of course, what was happening in Asia. I just thought I wanted to put that in context, given the significant losses we've seen. Again, as Asian currencies feel that strength of the US dollar, but also concerns more broadly about what a recessionary environment will do to some of the big exporters in that part of the world. So down 0.9%. Again, 6 straight weeks of losses in Asia. Futures stateside pointing to losses of 0.4%. And it's the 2-year back in focus. Yields up again, just by 1 basis point, 4.13 on the US 2-year, and the 10-year expectations now, you're going to get to 4% in pretty quick order. Again, this readjustment. Goldman Sachs, by the way, saying they see another 75 basis points at the next meeting of the FOMC. They've downgraded their forecast for the S&P from 4,300 to 3,600. The pound in focus ahead of that mini budget, 111. Look at that, 111, crossing from 112 down to 111 amid increasing concerns that you could even see a currency crisis here in the UK. And of course, that spending and the tax cuts tying in to that view from some. Down 0.6% in the session today. Sterling weakness, sterling vulnerability, again, in focus and a concern. Right, this week's blitz of interest rate hikes is unlikely to be the end of a campaign, of course, by global central banks to crush inflation.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
Inflation has been higher than projected. It has increased rapidly in the past few months, and that's also why a large policy rate hike was warranted at this time.
We do not exclude that further interest rate hikes are necessary. We are not very specific when exactly and to what extent.
To prevent price pressures from broadening in this way, we continue to urge timely, non-monetary government interventions to mitigate the impact of the supply-side pressures.
Okay, now Fabia Fedeli, CIO of Equities and Multi-Asset at M&G, joins us now, and Christina Kino from our Markets Live team. So a great panel to kick off the session today as we, of course, work around what is happening across central banks, inflation and recession risks. Christine, let's start with you then. The central bank action that we saw yesterday, a lot of it had been flagged, of course. 50 basis points is essentially what the BOE, ultimately what the BOE went with. We know there was debate around 50 or 75. There was, though, quite a lot of dissent and views from some, Goldman Sachs now, that you're going to get 75 from the Bank of England at the next meeting. They expect 75 from the Fed at the next meeting as well. So the hawkishness from central banks continuing despite these recession fears.
Absolutely, Tom, and that really tells you what the priority is for these policymakers, right? It really is getting a handle on that inflation aspect, even at the expense of growth. I would note that it is quite interesting, right? As you mentioned, the debate was for 100 or 75 for the Fed, 75 or 50 for the BOE, and both of these central banks decided to go for the relatively more measured rate hike this time around. I think that really tells you that what they really want to do at this point is save that firepower and leave themselves room to go even bigger if that would be necessary over the next few meetings. And judging by the way that things are going in terms of prices and all of the indicators that we're seeing from the economy at the moment, it seems like they could well need that firepower. So probably a prudent step from both policies, from both central banks this week.
Fabiana, talk to us a little bit about how much damage this, ever higher dollar does, not only for emerging markets, but actually G7 currencies as well.
Yeah, we see the dollar as continuing to stay strong. If you look at the relative strength of the U.S. economy versus other economies, by the way, everything obviously is right now relative because we have weakness across the world. But we would expect the dollar to stay strong. And this is obviously going to impact the euro, is going to impact the pound, and it's going to impact other currencies. Now, what this does to equity markets obviously is not necessarily straightforward because there are companies that benefit from weaker currency. So in the UK, some of the largest companies that are listed on the FTSE 100 actually will benefit and are also not exposed to the domestic economy. But from a macro standpoint, from a government standpoint, and also from a debt standpoint, that is a completely different point.
Hence the divergence we're seeing between the FTSE 100 companies and the FTSE 250, those domestic-focused companies. Christine, just on the point of currencies, we saw the intervention, of course, of the BOJ for the first time since 1998 yesterday, at least officials in Tokyo to support the currency, of course, after the BOJ reiterated its stimulus plans and its support plans. To what extent, and we're seeing this race now to kind of support currencies globally, what is the follow-through from this, a potential breakdown of this?
Well, Tom, I think now it's kind of a question of whether Japan will need to do more because markets at this point don't seem to fully trust that they will have more to give in terms of this intervention action. I mean, I think part of that was because we heard from the Bank of Japan yesterday as well. They were going to keep on this easing or relatively easy monetary policy track, even if the rest of the world is moving to tightening. And I think that's partly why the reaction in FX markets was thus to keep driving the yen lower, and therefore Japanese authorities needed to step in. And so I think what really needs to happen here is more of that evident sea change, at least from the Bank of Japan side, that it's joining the tightening fray. And then globally as well, I think, the pushback against weaker currencies, yes, it's definitely there. We're seeing it from Japan, obviously. China is not too far behind as well with their constantly stronger yuan fixings. But again, nothing like this really works very effectively unless it's coordinated action. And I would note yesterday was the 27th anniversary of the Plaza Accord agreement. So very timely discussions about intervention and currency strength.
Fabiana, do you think we need some coordinated action? Or actually, more importantly, if you think we need it, are we actually going to get it? Because it's the only way of making sure that, one man or one country's demise is not too much strength for the other.
Well, from a central bank perspective, I'm seeing we're actually getting coordinated action, with the exception of Japan, with some other exceptions such as Turkey, so they actually cut their interest rates. But with certain exceptions, actually we're getting central bank coordinated action. You've seen all the central banks across the world raising rates for the last couple of days. The difference is going to be in the fiscal policy. I mean, you have Italian elections, you have the mini budget today in the UK. What is fiscal policy going to do? In the UK, you're going to get yourself in this contradictory position where possibly the BOE will have to raise rates to counteract the growth that the fiscal policy is trying to trigger. So that coordination probably needs to be there.
Okay, Fabiana Fedeli, CIO of Equities and Multi-Asset and MNG, staying with us. We'll get more insights and analysis, particularly on the question of Italy after the break. Christina Kina, of course, from Alamo team. Thank you very much indeed. Okay, coming up then, Italy goes to the polls, of course, as Giorgia Meloni vies to become the nation's first female prime minister. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. We are about 10 minutes into the European trading day. Three things that we need to watch out for. First of all, Credit Suisse now down 6%. The bank denies a report of the U.S. exit, but of course there's been so many rumors on the fact that they would split the investment bank in three because they need to raise capital. So that bank under severe pressure. The other story is, of course, the mini budget in the UK, and the third story is Air in Rome. The background, not too bad. I'd say not too shabby as an assignment. Italy goes to the polls this weekend, bringing fresh uncertainty for investors really already fretting over rising interest rates, an energy crunch, and a potential recession. So we're back, of course, to talk Italy with Fabiana Fedeli, Chief Investment Officer of Equities and Multi-Asset at M&G. Fabiana, thank you for staying with us. When you look at the concern on Italy is that we don't 100% know what Giorgia Meloni, very likely to be the next prime minister's policies are. She keeps trying to reassure the markets that she's not the Eurosceptic that she used to be, that she will stick to fiscal rules and get the money from the EU Recovery Fund. But then you hear at rallies and she's just talking a different tune.
That is a key point, Francine. You've seen Meloni with a very conciliatory tone towards the EU. Now, let's not forget, they want that recovery money. So that was clear that they were going to try to be a little bit more pro-EU than they have ever been. Don't forget that it was the first stance of the EU that actually gave the government problems in 2018. So pre-elections, that looks fine. And in fact, you've seen it also in the BTP spread against the Bund. You've seen that it hasn't gone anywhere close to the 300 level that we saw back in 2018. But as you say, the rallies are telling you a different thing. What happens after the elections? And more importantly, this is a coalition of very strong egos. This is a coalition with heads of parties that, have very different opinions. So how this is going to be able to govern and what the impact is going to be to govern and what the impact is going to be on the EU, that is going to be key.
I love that, a coalition of egos, something to bear in mind when we look at the policymaking then coming out of any new coalition from Italy. So you're pretty comfortable with spreads as they are, as things stand. Of course, there's going to be a risk they blow out, depending on what the policy is. In the immediacy of the election, if indeed we get what the polls are suggesting, which is this right-wing coalition, is it a case of kind of buy the rumour, sell the facts? Is there going to be a sense of relief amongst these markets?
I don't think so, Tom. I actually think the risk is on those spreads, just because they haven't risen as much as we have seen them rise in the past and when we had a similar election environment. So the risk is clearly on the Treasury side here. And possibly also on internal demand. To some extent, it will have a reflection also in the equity market because cost of funding would go up, but less so there and more on the BTPs.
Fabiana, when you look at the biggest concern, and this would be some kind of messing up of the EU rules, again, what happens to that spread? And the key question then is, then does the ECB feel comfortable, if it's for political reason that the spread widens, to intervene with their new tool?
You know, that's the $60,000 question, really, Francine. At some point, they will have to intervene. The point at which they decide to intervene, obviously, is, you know, we don't know. And it will also depend on what kind of line the ECB is going to take or the EU is going to take with Italian politics. If you remember, they took a very hard line in 2018. They might decide to keep that hard line if they see that the new policies from the government are not in line with what the EU wants. So the spreads are not looking good at this point in time. They seem destined to go up unless we have a real positive surprise in the conciliatory tone of the new government towards the EU.
Fabiana, thank you so much. Fabiana Fedeli, their Chief Investment Officer of Equities and Multi-Assets at M&G. Now, I have to say, Tom, yesterday I was at this rally. We heard Silvio Berlusconi. Do you remember him? I mean, he was on fire. And then we heard from Matteo Salvini and Giorgia Meloni. They were on the same stage. And I have to say, it was quite immigration. It was focused on values. It was focused on family values. And it sounded a whole lot like Donald Trump right before he got elected. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Credit Suisse has denied plans to leave the U.S. market following a Reuters report that it was considering a withdrawal for its investment bank. The story also says Credit Suisse is sounding out investors for a possible capital raise. The bank is undergoing its second restructuring in less than a year, but says any report that it's leaving the U.S. market is categorically false. Boeing has agreed to pay $200 million to settle SEC allegations that it failed to disclose safety issues with its 737 MAX jetliner. The settlement concludes a probe into whether the plane maker withheld key information about a flawed software system linked to 2 fatal crashes of the model. Neither Boeing nor its former CEO have admitted or denied the findings. FedEx is cutting flights, deferring projects, and closing offices. The courier is seeking savings of as much as $2.7 billion to tackle challenges including slowing demand and a tight labor market. It's also revealed plans to raise shipping rates after withdrawing its annual forecast and posting lower than expected preliminary results. Chinese battery maker CATL says it's considering a third factory in Europe. The company's first European plant is due to start production in Germany later this year, and it recently announced plans for a factory in Hungary. CATL's European president says a third plant depends on demand, flagging challenges from the continent's energy crisis. That's the Bloomberg Business Flash. Tom, Francine.
Okay, Laura, in London, thank you very much indeed. Coming up, Wall Street bosses prepare to shed staff and bring down bonuses, marking the end of boom times. More on that story next. This is Bloomberg.
When the Fed makes its call,
a unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then dissuade you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs. And to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
Welcome back to the Open. We are 21 minutes into the European trading day. Losses of 0.4% across the benchmark here in Europe. The Stock 600 future stateside also pointing lower by between 0.4 and 0.5%. But it's the action in the currency markets this morning that is again really the focus of our attention. You've got the Bloomberg dollar index at a 20-year high. You've got the euro at about a 20-year low. Currently, it's crossed below 98 now. It's 97.92. In terms of dollar cents that you get per euro, 97.93. That is a drop of more than 0.4%. Sterling as well, continuing its downward spiral, 111 now on the pound. That is a drop of 0.6%. The context is it is at a 1985 low now, the pound. As we look ahead to this mini budget, of course, from the new Chancellor of the Exchequer, and significant concerns from economists out there that this is going to add to the inflationary risks for the UK economy. That is arguably, the BOE would say, potentially already in recession. So the pound again in focus, 111, euro at 97, and the Bloomberg dollar index at a 20-year high. We continue to watch these moves for you. Francine.
Now, as the economy slows and financial markets slump, the mood, of course, on Wall Street is quickly changing. Now, the sense that it's the employees' jobs market where they can set their own terms is actually fading as some companies prepare to shed staff and bring down bonuses. So let's focus on this. Let's see exactly where this ends up with Bloomberg's Europe finance reporter, Nicholas Comfort. Nick, as always, thank you so much for joining us. So what's behind the job cuts and where exactly are they taking place?
Well, it's a slowing market in deal making. So, I mean, with all the uncertainty coming from the war in Ukraine, corporate executives aren't willing to really pursue big ticket M&A at this stage, which means fewer fees for the advisory side at banks. But then that has a whole cascade. I mean, so if there are fewer deals being done and less issuance in terms of bonds and equities as well, and notably in leveraged finance, so the financing for buyouts by private equity firms, and this means that there is less work for these bankers to be doing. And we had the big news from Goldman Sachs 2 weeks ago about reintroducing their annual culls, and where Goldman goes, other banks follow.
Yeah, what a turnaround just in the last kind of 6 to 12 months, from a time when executives were desperately trying to get hold of staff to fill those gaps and take some of the workload. Do you expect to see bigger waves of job cuts in the months ahead?
I think that may be the exceptions. We have had some really big waves of job cuts at various European banks, especially over the last couple of years. Now, the notable exception being Credit Suisse. I think that's something where we are likely to see, when they communicate their strategy update at the end of October, it's widely expected that there'll be several thousand jobs as well going there, probably company-wide, not necessarily just the investment bank, but the investment bank will be a big focus there. yeah, they would be the exception to the rule.
So, Nick, what does this mean for work from home policies, and how do US and European banks compare?
Yes, this has been a big focus, obviously, for employees of banks. I mean, they enjoy the freedoms that we all did. I'm working from home today. But this is something that banks, especially US banks, didn't feel super comfortable with in the first place, where they kind of had to accept it. And now I think it's fair to say that the pressure on employees to return to the office they'll feel it a lot more strongly, because they know that their jobs could be on the line here. They want to be making the best possible impression. The European banks have, on the other hand, have been formalizing their work from home policies. A lot of them kind of shaking in at sort of 2 days a week, generally is kind of the norm for roles that allow it. And they see this as a competitive advantage. You got to say, I mean, how much of a competitive advantage is it in a market where staff aren't so badly needed? But this is something which the banks so far say they are sticking to in Europe.
Okay, Nick, just briefly, of course, we had these reports that the UK is going to be scrapping the cap on banker bonuses. Have we had any more reaction from the industry?
I mean, that's UK bankers are obviously looking forward to that one. It could be good for them. But again, I mean, I guess we're in a cycle right now where bonuses probably wouldn't be rising that much anyway because of the market drought for deals. But yeah, it's clearly something that they're looking forward to. And I could anticipate the European banks would be saying, what the heck, now we have this competitive disadvantage to Barclays and to other UK peers.
Okay, Bloomberg's Nicholas Comfort from the comfort of his own home, of course, working from home. He's rubbing that in a little bit there, Nicholas. Thank you. On the job cuts across the finance industry, what it means in terms of the talent war as well going on across that sector. Thank you very much. Now, coming up, stocks sink and the dollar batters its peers. We have plenty to discuss in the markets with Saxo Bank CEO Kim Fornace next. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back, everyone, to The Open. We're 30 minutes into the European trading day. I'm Francine Lacqua here in Rome, looking at the elections on Sunday. Our Tom McKenzie is in London with our top stories. Hi, Tom.
Good morning, Francine. Now, market maelstrom, yields surge, stocks sink, and the dollar once again batters peers as central banks around the world unleash recession fears. Italy votes. We are live in Rome in what could be an historic election. And fiscal boost. New UK Chancellor Kwasi Kwarteng is set to unveil stimulus plans today. Let's check in then on these markets for the context of where we are in the UK. You did have UK consumer confidence overnight coming into the lowest levels on record since the 1970s. This ahead of that mini budget, of course. The pound under pressure once again today. Just a red head crossing the terminal. Germany's September services PMI falling to 45.4. The forecast had been for 47.2. So just underlying the slowdown that we're seeing in the German economy again as economists increasingly bet on a recession across the Eurozone. The Stoxx 600 currently down 0.2%. Over in Germany, the DAX currently off 48 points, down 0.4%. Here in the UK then off by 0.2%, again ahead of that mini budget and on increased concerns about the health of the consumer here. By the way, Goldman Sachs downgrading for the S&P, their forecast from 4,300 by the end of the year to 3,600, and they are expecting another jumbo 75 basis point hike from the Fed at the next meeting. Across your sectors then, a bit of a shift into safety in terms of where people are positioning. Healthcare at the top of the list, gains of 0.7%. You're seeing very heavy losses, or particularly heavy losses, across the energy sector, down 1.5%. Autos also lower, basic resources as well under pressure by about 1%. Banks also feeling the squeeze. Credit Suisse is another story, denying the reports that it's planning to end its business and pull out of the US, but nonetheless the stock taking a hit this morning. Okay, let's get the Bloomberg First Word news now with Laura Wright. Laura.
Thanks, Tom. Japan is to abolish many COVID border controls from October the 11th in a move to revive the tourism industry. Prime Minister Fumio Kishida says individual visitors would be allowed to enter with visa waivers reinstated and a daily cap on arrivals removed. After reaching a record of almost 32 million in 2019, visitor numbers slumped last year to less than 250,000. Iranian state television says at least 17 people have now been killed in protests following the death of a woman in police custody. Masha Amini died after being arrested by Tehran's so-called morality police for allegedly breaking dress codes. It's triggered the most widespread unrest in nearly 3 years. Protests have been reported in the capital and dozens of towns and cities. Singapore has overtaken Hong Kong, battered by strict COVID restrictions, to become Asia's top financial centre and the third in the world, according to the Global Financial Centres Index. New York and London remained in the first and second spots, while San Francisco moved up 2 places to make the top 5. 10th placed Paris was the only other European city to make the top 15. Global news 24 hours a day on air and a Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Okay, Laura, right here in London. Thank you. Now, stocks and US equity futures extended declines at the end of a week that underscored expectations for tighter monetary policy and a slowing global economy. Joining us for more and for analysis is Saxo Bank founder and CEO Kim Fornace. Very pleased to say joining us in the studio. Kim, good morning. Thank you for joining us.
Thank you.
Just give us, we'll take a step back and just assess what's happened just in this week alone in terms of central bank action. What is your view on how the markets are going to be reacting in the days and weeks ahead to this?
Well, we have a situation where the debt levels in the world have never been higher, and debt is increasingly growing in the midst of all of this. And servicing the debt obviously gets a lot more expensive, and we see inflation raging, and we see rising interest rates. So I think this is not at all ending anytime soon. We started talking about inflation very early last year, where no one said, no, it's not going to happen. And honestly, I don't think it's a major surprise, because when you pump out money like that, and you've done that for a long time, really punishing people saving money, as Milton Friedman said, that inflation is a monetary phenomenon. And I think that what we're seeing now is really the result of all of that. Then obviously further accelerated with war in Ukraine, COVID, all sorts of things. So not see any relief anytime soon, unfortunately.
Kim, good morning from Rome. I think you can hear the bell singing. I mean, there's the Vatican behind me. I have to say it's beautiful, and it kind of distracts maybe from some of the concerns that the market is not quite getting to grapples with. If this is a new normal of higher inflation, what happens to market correction? So could we see treasuries at 5%? And why is the market not seeing that now?
Well, I think everyone believes and hopes, of course, that this will end. And I think also it's a very uncertain situation with what's happening in Ukraine, where obviously, I mean, if that stopped tomorrow, there probably would be some relief rallies, I think is undoubtedly the fact. But I just don't see we are at that point right now. So politicians obviously trying to, again, not do the necessary reforms, but really trying to solve it with adding more to the budget and trying to really relieve the pain of everything that's happening there. I'm not sure that's going to have any immediate impact. I think it could potentially spur additional inflation with then subsequent more rising interest rates and many people having both the inflation to battle with, higher interest rate energy prices, interest rate prices, food prices, and so forth. So it's hard to see how this can be fixed super short term.
Do you think, Kim, do you think the Fed keeps going until something breaks, ultimately? Are you concerned about a policy mistake?
Well, when you talk about something breaking, it's like it's inevitable that the stock markets needs to go up and up and up and up without a major correction. I think in history of mankind, we have had boom and bust cycles. And I think that sometimes, you know, it's kind of needed because clearly there's so much money pumped out there that I think a lot of these debt burdens will have a hard time getting paid back. So I think that they're probably going to be more of a washout. I think that actually long term is not necessarily a bad thing. But I do agree. I think shorter term to mid term, it's a more gloomy picture. But then, of course, now we begin to see interest rates coming up. I think for savers, of course, inflation is eating everything up. But it is, I think, a correction that one could have expected.
But Kim, so give us a sense of exactly what this means for who could go bust. So is this margin calls on energy? Is it, you know, some of the private equity, some of the hedge funds, or is it actually, you know, shops of mom and pops that could go bust in the cycle?
I think if you go throughout the sector, whether you look at debt burdens for countries, for companies, and so forth, and even individuals, it has gone up significantly. If you think about the private equity part, well, there's been a lot of very, very cheap financing. A lot of additional financing was available at very low rates. And I think it's going to get more difficult now. So I think if you owe a lot of money, if you don't have a good cash flow, if you're in the need of credit and not really credit worthy, I think it's going to be a problem, right? So on the other hand, there are clearly sectors now that is very much needed. And again, you mentioned the energy, but they are getting big margin calls now. I think most people around the world are trying to help, seen from a government point of view, to make them fill up those margin calls, because of course that could be really devastating if you don't meet the margin calls. Right?
And Kim, just in terms of client activity, you've taken a bit of a hit, of course, given everything that's going on. Do you expect that to continue amid this kind of gloomier environment, the higher rates environment, the inflationary environment, the recessionary risks? What is it doing to client activity?
Well, what we have is we have kind of very sophisticated, I would call, traders using derivatives that are also going short in the markets where they're actually quite active now. We haven't actually really seen a drop there. And we have more kind of long-only approaches for longer-term investors, which obviously has more of a risk-off proposition, right? So I think it's a little bit combined. We're probably around the index 95 on revenues now compared to last year, which is of course sad, but so it's not a disaster, but we actually do see differences in different client segments' behavior. I think that it's a little bit interesting also that when prices are falling, people don't want to buy, which is kind of unusual.
How much cash is on the sideline from your clients?
Our clients have very, very big portions of cash on the sideline, which I think is a healthy sign, right? Because eventually, of course, you have to buy. And I mean, if you're not in the market at all, it's probably also a good idea to, on these really bad down days, to maybe start filling up a little bit, right? But I think it can be volatile, and I think it will for some time to come.
Okay, Kim, thank you very much.
Thank you so much for having
Saxo
me.
Bank founder
Kim,
and CEO, Kim Fornace. Thank you for coming into the studio, giving your views on what's happening across these central banks and client activity, of course, as well. Coming up, the UK government is set to unveil its mini-budget to stimulate the economy. We'll get reaction to that next. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back to the Open, everyone. 42 minutes into the trading day. The focus today on three things. First of all, Credit Suisse, so watch out for anything to do with banks severely under pressure after rumors of them splitting the investment bank, raising concern about capital. And of course, the U.S. The second story is Italy going to the polls, of course, on Sunday. This is why I'm in Rome. And then the third is the U.K. The government there is setting to announce a mini budget today aimed at really boosting economic growth. Now, it comes after the BOE delivered a second consecutive half-point interest rate hike in its battle to bring down inflation. So let's get more now with Bloomberg's Lizzie Burden, who's in Westminster with a very special guest. Lizzie, over to you.
Thank you, Francine. I'm joined in Westminster by Mel Stride, Chairman of the Treasury Select Committee. Mel, thank you so much for joining me. You've written to the Chancellor Kwasi Kwarteng, urging him to allow the fiscal watchdog, the Office for Budget Responsibility, to assess the economic impact of this mini-budget. But Kwarteng says no. What's his excuse?
Well, I think he's saying this isn't a full budget, and therefore we need to wait until there is a full budget, which is in the autumn. But of course, what we know is that the kind of measures that we're expecting this morning are certainly very similar to a full budget. In fact, Paul Johnson, the head of the IFS, described the tax measures alone as being the most significant since Nigel Lawson in 1988. So this is a very major fiscal event, and we should have an independent forecast to accompany it.
Does the lack of a forecast undermine the government's economic credibility?
It makes it more difficult to underscore that credibility, because whilst all sorts of political commentators and think tanks will clearly have their own forecasts, there is none better than the independent forecaster, the Office for Budget Responsibility. And that's very important in terms of the markets, because we've seen pressure on bond yields, particularly very recently, and also on the currency. And what those markets want is transparency, and they want to know that whatever it is the Chancellor announces this morning is done in a fiscally responsible manner.
Indeed, we were speaking to former Bank of England policymaker Martin Wheel yesterday. He warned that there could be a run on the pound if these plans go ahead. Would you go that far?
Well, I don't get drawn into that kind of speculation, but I really restate what I've just said, which is that if the government wants to really underscore its fiscal credibility here, and that is very important, because people only lend to us because they have confidence that we're making the right decisions economically, then the best way of doing that is an independent forecast. And so we will continue as a committee to push for that. We know it was possible to deliver because the head of the OBR wrote to us to confirm that. So the Chancellor could have come forward this morning with an independent forecast, and it's regrettable that he's decided not to.
But you ran former Chancellor Rishi Sunak's campaign to become Conservative leader and Prime Minister. You're a bit partisan in this, aren't you?
No, not in that sense at all. As the chair of the Treasury Select Committee, we're there to hold the government, of whatever colour or whoever's leading it, to account. And my guiding star has been doing what is fiscally responsible to do, and that includes forecasting.
But Rishi Sunak was MP's choice for leader. Given some of these measures are going to require parliamentary votes, will Liz Truss actually be able to get them through Parliament?
Well, we have to wait to see what the Chancellor suggests, but let's not get distracted too much by the fact that a lot of what the Chancellor is going to announce this morning will be extraordinarily welcome. This is going to be a huge fiscal intervention there to support millions of families and businesses up and down the country, and that's a very good thing. So I suspect that broadly we'll be welcoming these moves, but there is a question mark, I think, around the fiscal implications of what's going on here. We could have a very long conversation about that, but no time to do it. And the best way of really answering the questions in that space is to have had this forecast.
Are you concerned that these measures will add to inflation?
I think well, some of the measures will bring inflation down. So the actual capping of energy costs will, the Bank of England thinks, take 5% off the level of inflation in the near term. But in the further, more medium term, it probably means that inflation will be higher for longer, and that will mean higher interest rates in the future. So there's no free lunch here, I'm afraid.
And in his letter to the Bank of England Governor Andrew Bailey yesterday after the bank's decision, Kwarteng said that he was absolutely committed to Bank of England independence, but there was no mention of mandate review. Do you think the government scrapped its plans to review the Bank of England's mandate?
Not necessarily. I think what they have clearly signalled is that they're not going to interfere with monetary policy, and that's really important, because during the leadership campaign, it rather looked like politicians wanted to start setting interest rates and so on, or that was one of the suggestions. I think the government quite rightly and very clearly backed away from that. Whether they will want to look at exactly what the remit of the Bank of England is in other respects, that's a possibility, and that's a conversation that may be worth having. But I think the absolute independence of the Bank of England is fundamental and must remain.
And you frequently have Andrew Bailey and co in front of the Treasury Select Committee. They've been accused of being behind the curve, especially when the Fed's doing 75 basis points, the pound's weak. Should they have gone for a bigger hike yesterday?
I suspect it's probably about right, the 50 basis points, but we will have the bank in and we'll be asking them questions about why they came to what at the end of the day was a three-way split on that decision amongst the members of the Monetary Policy Committee. But overall, I give the bank fairly high marks, even though inflation has risen, because a lot of the pressures that have come through on the inflationary side have been external pressures, which have been very difficult to foresee ahead of time. And remember, monetary policy takes about a year, 18 months or more to kick in, so it's a very difficult thing to get right.
Mel Stride, Chairman of the Treasury Select Committee, thank you so much for joining me. Well, we're going to get that mini-budget later today. The questions remain, will it add to inflation? Will it boost growth? And how much borrowing is it going to necessitate? What will be the blowback for markets?
OK, Lizzie Burden at Westminster, thank you. An important interview there. Some redheads crossing the line. We want to just get you up to speed with Hong Kong then, entering its hotel quarantine from September the 26th. So in 3 days' time, they will be ending that city, the hotel quarantine mandate. This is a significant shift for a city, of course, that had hoped to open its border with mainland China. It now seems to be focusing on ensuring that international visitors and Hong Kong residents can get back and access that city easily. The other lines crossing here, that Hong Kong residents who are not vaccinated can enter the city. That is according to the chief executive. And Hong Kong will scrap pre-arrival COVID PCR tests. So a significant shift following some pretty draconian restrictions that have been put in place by Hong Kong. And clearly they would have had the blessing from Beijing to go ahead with this. The top line is that hotel quarantine will be ending from September the 26th in Hong Kong. Okay, coming up, Singapore overtaking Hong Kong, battered by those strict COVID restrictions that are now, as you hear, starting to ease, to become Asia's top financial centre and the third in the world. That story is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open, everyone. 52 minutes into the European trading day. Yes, we look at European stocks, but I have to say a lot of the commotion is on fixed income. Certainly here we look at the BTP and German Bund spread, and then, of course, quite a lot going on currencies. Tom and I will get you through that action. For the moment, European stocks down some 0.4%. So Singapore has overtaken Hong Kong, battered by strict COVID restrictions, to become Asia's top financial center and the third in the world. That's according to the Global Financial Centers Index. So they can't be wrong. Joining us now is Bloomberg's Singapore Bureau Chief Joyce Koh. Joyce, thank you for joining us. So what are the steps that Singapore has been taking to actually grow as a financial hub?
Hey, good morning, Francine. Hi, so I think, this ranking is testament to the efforts that Singapore has been making over the past few months to really attract talent and making it an attractive place for people to consider setting up their businesses, invest here, and just be a welcoming place for talent. Over the last few months, we've seen Singapore come up a new visa for foreigners earning at least Sing dollars 30,000 to get a 5-year visa. The government has said it plans to create 20,000 finance jobs over 5 years and sees the sector really growing. So there's lots of excitement taking place in the city right now.
How much of this is about poaching talent and seeing moves into Singapore from Hong Kong? How much is this about the demise of Hong Kong as a key financial sector?
Well, in Singapore, we never ever talk about the demise of Hong Kong. I mean, in fact, I think officials here are very careful not to overplay that rivalry in Hong Kong, between Hong Kong. In fact, from the talks and the interviews we have with many of them, they like to talk about the growth of the region of Southeast Asia as a gateway to India also. And obviously, we hear of people and talent moving to Singapore, attracted by the stability. I mean, our COVID restrictions that have been dropped earlier this year. We do see people coming, and we do see, and that has had a knock-on effect on a lot of things in the city. Rents are rising, restaurants are getting filled, lots of conferences taking place. So yeah, that's quite a bit happening.
Okay. And of course, the New Economy Forum hosted by Bloomberg as well in November. Importantly, Joyce Koh, thank you very much. Bloomberg's bureau chief there over in Singapore, and how they have topped Hong Kong in terms of financial centres. Thank you. Just checking back in on your currencies, because once again, the wrecking ball of the US dollar at play when you look at the euro and sterling, and I'll mark the Japanese yen as well. That's at 142 after that intervention, the first time since 1998 yesterday. Sterling at 111 now, down 0.7% ahead of this mini budget. Euro dollar 97, down 0.6%. Briefly looking Italian yields, 410 Francine on Italian 10 years.
Yeah, I would urge everyone to also go check out our live blog. We don't only talk about Italy, but our Christina Kino just put out this wonderful post saying, look, it's the kind of coordination needed to curb dollar strength that is underway, that needs to be reinforced if anything's going to happen. She's also saying, of course, the two elements is that for central banks, especially the G10, they need to match or outdo the Fed in terms of rate hikes. So I'm looking at currencies. I can do that with my portable Bloomberg. The other thing I'm looking out for is, of course, the election. We're just here right behind me is the Vatican. I don't know whether we'll get white smoke on Monday to see who gets elected and whether we have the first, of course, female prime minister, because there's so many questions on what she means for the markets. Is she going to be Eurosceptic? She's promised she won't be. She promised she'll be pro-EU. The proof is in the pudding, Tom.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
We are ready to be active on the foreign exchange market if the Swiss franc would become very too strong, massively overvalued, or when the Swiss franc would become too weak.
We are seeing signs of a slowdown. Growth in mainland GDP has slowed.
We've had other previous experiences where chancellors have gone for growth and they both ended in tears. And I must say I expect the same sort of thing will happen with Kwarteng's policy.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. We're covering the elections. Congratulations, everyone. It's Friday. If you've made it through the week, you have another difficult week coming next week, but at least it's almost the weekend. Here's what's coming up on today's program. Market maelstrom. Well, we look at equities, yields surging, stocks sinking, and the dollar batters peers as central banks around the world unleash recession fears. Italy votes. We're live in Rome in what could be a historic election. That's on Sunday. We'll get, of course, the results on Monday. And fiscal boost. The new UK Chancellor, Kwasi Kwarteng, has said unveil its stimulus plans today. So first thing is first, and frankly, everything, all of these political, foreign affairs issues, the rising energy costs, the cost of living is really playing out in this mega battle amongst central banks. So that's playing out on the markets. I'm looking at stocks and also U.S. equity futures extending declines at the end of a week that underscored expectations overall for, of course, tighter monetary policy and a slowing global economy. We were speaking to our Christina Kino, and I urge everyone also to go on our live blog. It's both on the terminal but on the website, where she goes. And some of the things she asks is basically, do we now need a plaza court? If you look at what's happened to yen this morning, after they tried to intervene, it's very clear that that's short-lived. So if you're not going to act in coordination, where do you actually end up? And that's really up to the G10 currencies to either try and fight the Fed or even go higher than what we're expecting. Investors flocking to cash, shunning almost every other asset class as they turn the most pessimistic since the global financial crisis. That's according to Bank of America strategists. Now, we also have some manufacturing PMI, pretty much as expected, 48.5, and the forecast was the same. So that's a bit of data. We'll go on to Italy in a second. I don't know if we have the European map. If we do, I'm going to get my sunglasses. The beauty of Rome, guys, is really unprecedented. So even if the markets are falling out of bed, you're in a better mood if you're here in Rome, and then maybe if you're somewhere where it's raining and gloomy. This is a picture. We're seeing quite a lot of red across the board. I think out of the 19 industry groups that make up the Stoxx 600, nothing is actually gaining in today's trading session. The 10-year Treasury yield holding near 3.7%. So this week has seen a blitz of interest rate hikes in an ongoing campaign by central banks to crush inflation, even as they run the mounting risk of driving their economies into recession. Now, from the United States to the Philippines, policymakers lifted their benchmark borrowing cost during a 3-day window that made it clear that their chief worry is the hottest run of inflation since the 80s.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
Inflation has been higher than projected. It has increased rapidly in the past few months, and that's also why a large policy rate hike was warranted at this time.
We do not exclude that further interest rate hikes are necessary. We are not very specific when exactly and to what extent.
To prevent price pressures from broadening in this way, we continue to urge timely non-monetary government interventions to mitigate the impact of the supply side pressures.
Now we're joined by Fabrizio Pagani, Global Head of Economics at Muzinich & Co. Fabrizio, thank you so much for joining us. I mean, it's been such an incredible, fast-moving week that it's quite difficult for the markets to catch their breath. Is there now an understanding that King Dollar will just go ever higher?
Possibly. Today is really hiking
it's
a
rough
lot.
for the others.
Yeah, it's rough for the others. Let me say, there is a lot of volatility in markets, right? And I mean, these hikes across the week and across the continents have been quite momentous. At the same time, I have to spend a couple of words in defense of central banks. I mean, they have told us. They have told us repeatedly, and I think the world central bank, which is the Fed in Jackson Hole, Powell has been very clear that they will fight inflation. Period.
But so what's the so I spoke actually when I was in New York. I spoke to a former central banker who shall remain anonymous, and he says, look, yields should go to 5%. If you just believe what central banks have been telling us, we're going to see treasuries at 5%. Why is it taking so long? Why are the markets so hesitant to reprice?
Well, there are two aspects. I think markets have been a bit reluctant in repricing because they didn't believe the central bank's determination. And indeed, at the beginning of the year and last year, there was some uncertainty on how strong and determined central banks were in hiking. This combination of hiking rates and ending QE was a bit complicated to handle.
Can we agree on the economy, and maybe we disagree, that inflation is actually the worst because it kills especially, the benessere, the living of the people that are just about making it, and so politically this has to be dealt with.
We can agree on that, definitely. At the same time, I think inflation in Europe and in the US is different, and we should never forget that. In Europe, it's really energy. I mean, there is a recent study by Bruegel, the think tank, which shows that if prices will go back to February, energy prices will go back to February levels, which were higher than usual, of course, already very high, inflation will go down to 3.8%, which is high but bearable. So I mean, in Europe is really energy. Energy is king.
I know, but energy, then it's cost of living. So I don't know if you've asked for a raise recently. If not, you should. Mr. Muzinich, you're going to get a call from Fabrizio once we get off air. But the point is that there's a spiral, and once you lose that inflation spiral, then central banks are powerless.
That's true. This is why Powell is so critical for Powell to rein these inflation expectations, and it's all about inflation expectations. Basically, the fact that if an inflation expectation that you take decision thinking that the prices will be higher and higher, for a very long period, and this is really destructive for the economy.
Can we really avoid a recession in the U.S. and globally?
I think we may, it's a narrow path, but we may have a technical recession. So I always say that we want a recession which is an economist's recession. So a recession which is really felt and gauged exclusively by technicians, but people perhaps can go ahead with just as low down. But it's a narrow path.
Fabrizio, going back to these currencies and also King Dollar, there's more and more talk about a possible Plaza Accord, that the other countries to come together, and if they don't do it together, if it's not coordinated, then nothing will happen. It won't make a difference if the Bank of Japan does this or the Swiss bank does that.
I think there are two sides, because at the same time, this coordinated tightening of monetary policy is helping, because we have an inflation pressure across the world. So, with perhaps the exception of Japan, so it helps and may be more effective to do it all together in a synchronized way. At the same time, I understand, and Powell somehow confirmed in the press conference, that they are talking each other all the time, the central banks, in Basel and in other fora. He has the FSB and the Basel Committee and so on. And so on. So I don't know if we need a formal agreement, but certainly we have always to be mindful that the financial system is so fragile, And this type of volatility and this type of movement can be really damaging.
All right, Fabrizio, thank you so much. Don't go anywhere. Also, because the view is beautiful, but we have to talk about Italian politics. This is a problem with Italy. It's always so beautiful that you never really quite understand the severity of what could happen. Fabrizio Pagani, Global Head of Economics at Music & Co. Now, coming up, Italy goes to the polls this weekend, so we'll have plenty more on that next. And this is Bloomberg.
With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the Amazon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Business, economics, politics. I'm Francine Lacqua here in Rome, of course, looking at the Italian elections. Oh my goodness, we've had no sleep. The Italian elections, but of course they will have a huge implication for all of Europe, including France and Germany. Now we're also getting some breaking news on the markets. The UK FTSE 250 has fallen to the lowest level since November 22. Now the difference, of course, between the 250 and the FTSE 100 is that the FTSE 100 is extremely rich when it comes to big multinationals. It also has BP, so it has a huge natural resource construction, which sometimes doesn't capture the full effect of pound weakness or concerns about the UK economy. Now, the political landscape in Europe is shifting. Italy goes to the polls this weekend. After over a year of relative stability under Mario Draghi, Italians and investors face uncertainty as to what lies ahead in their government. We're back with Fabrizio Pagani, Global Head of Economics at Music & Co. Fabrizio, thank you so much for sticking around. So we cannot talk about the polls, but it is very likely that Giorgia Meloni becomes the new prime minister with this right-wing coalition. I was at Piazza del Popolo. I saw Silvio Berlusconi, Matteo Salvini, Giorgia Meloni, all giving some pretty feisty speeches. What does this mean for investors?
I think investors will look at two things. They will look at the key positions in government, particularly who will be the Minister of Finance, and we'll look at what the government does in the first 2-3 months, particularly in the implementation of the next generation EU national plan and the budget law, which is due by the end of the year. So far, I mean, if you look at the program of the different parties and different coalitions, there is not particularly in economic terms, there is nothing particularly shocking.
Yes.
So there is nothing, there is not like 5 years ago or 10 years ago when the really anti-Euro and anti-European Union strong positions. Today, everything is more moderate.
I know, but so the concern, and we know Giorgia Meloni is trying to be a conservative, basically mainstream politician, but underneath that, there are still undercurrents of Euroscepticism from the past, of Italy first, of closing down the borders. So the danger is what, in the next couple of months, that they somehow change and you see the true colors, or do you think they'll stay the course?
I think the danger is probably in the medium term and longer term, if they stay in power for a long period, of basically feeding up anti-European sentiment in a more subtle way. So in having frictions with the European Union and in having a sort of complaint mentality vis-a-vis the European Union, the central bank, and so on. And the second danger is structural reform. I mean, we are committed to do structural reform according to the National Plan of Resilience and Recovery. So and it's a very long list. We are not certain how much determination there will be by the new government, particularly if it's a center-right coalition, in doing structural reform. And that will be scrutinized very closely by investors.
So, Fabrizio, you made, of course, this excellent point that a lot will depend on who's finance minister. From the rumors I hear, but you're much closer to this than I am, from the media also talking, it seems like he could be a mainstream name, right? I mean, I think there's Lorenzo Binismaghi on a possible list that nothing's confirmed. You have ex-bankers. Like, who do you think it will be?
I can't comment on names.
But you think it's someone that the market, could know, or at least would be reassured?
I think Giorgia Meloni is a skilled politician, and if she will be, it's always an if she will be the premier, she will choose someone who's probably well known by market and accepted by investors.
So one of the difficulties, of course, and again, she has said, but without freaking out Europe, that she needs to renegotiate what you were talking about, this recovery fund, because we're going into winter, and maybe a lot of our international audience doesn't realize exactly, how difficult here in Italy it will be because of the closeness to Russia, to Russian gas, to Russian energy. I mean, should they spend a little bit more given the high debt?
I mean, there are two things. One is the national plan, which is under the Next Generation EU, which is a huge amount of money, which is around 200 billion.
Yeah.
And this is more a question of really implementing it. We don't need more money, and you can adjust at the margin.
Yes.
And some changes can be made in accordance, with the Commission, talking with the Commission, negotiating with the Commission. The second aspect is the budget, and on the budget, Giorgia Meloni seems, from what she's saying, quite conservative. For example, she doesn't seem to accept that there will be a revision of the budget with a fiscal expansion in order to shore up families and companies further from energy prices.
Fabrizio, there's also a new tool, of course, by the European Central Bank, saying that they can intervene if there's a widening of the spread. I mean, this would not be used, am I correct, if the spreads widen because of politics in Italy?
That's a good question. It's a bit like the revolver of Chekhov. When you put it on the scene, someone has to use it. So we have this. Frankly, I think this TPI is a great instrument, and I've been advocating and praising it since the beginning, because I think we already see its effects, because only the fact that it exists, even if the mechanic may be a bit difficult to really put it in place, is having an effect on market. Let me just say that to all the Eurosceptics in Italy, the ECB has been buying around 350 50 billion of Italian debt in the last couple of years. I mean, that should be enough to be not Eurosceptic, at least.
All right, Fabrizio, thank you so much. Fabrizio Pagani there, saying it as it is, Global Head of Economics at Muzinich & Co. Now, we'll have plenty more, of course, from Italy throughout the day. Also coming up, we bring you more from Rome as Italians head to the polls over the weekend. We'll look at the role that inflation and energy will play in their decisions. We speak to the former Eni chief executive, Paolo Scaroni. This is Bloomberg.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They are saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then dissuade you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome ahead of the elections on Sunday. Now, let's talk about energy as well. We will talk a little bit later about Italian politics, but we're joined now with a man who understands energy and also the close connection of Europe and Putin like no one else. He is Paolo Scaroni. He's chairman of AC Milan, deputy chairman of Rothschild, but for many years he was the former chief executive, of course, as Eni. Paolo, as always, thank you so much for coming on. Many people don't understand the relationship, for example, of Gazprom and certain prices, the fact that I think they pay less, the Germans pay less than the Italians or the French with some of the PAP flows. When do you see a resolution of the conflict that would lead to more normalcy in terms of energy flows between Russia and Europe?
This, I would probably say never. No, never is not a word that makes a lot of sense, but meaning by never, I say for maybe 10 years or something like that. This relationship which made Russia as the Texas of Central Europe, because in fact it has been the Texas of Central Europe for 70 years, is finished now.
So what does that mean for a country like Italy that has hugely reliance and close ties? I know Italy's looking for oil elsewhere. It's going for countries in, for example, Africa, where it has to pay a lot more for its energy.
No, oil is not the problem. The issue is all around gas. No? Now, luckily, Italy has other pipelines with Algeria, with Libya, and with Azerbaijan, which are providing some gas. And oddly enough, we still have a flow of Russian gas, which crossed the Ukraine and arrives in Italy. And this gas, which is roughly 25 million cubic meters a day, if it continues, we have the assurance that Italy will not suffer during the next winter.
But how difficult will be the next winter or the one after? I mean, I remember Mario Draghi saying, you know, we have to choose between peace and having air conditioning. What happens in the winter where we're choosing heating?
Well, personally, I think that the consumption of gas will be dropping so much, particularly from industry, that we will not have a problem of supply. Now, of course, we have a problem of prices, which is a completely different issue, because prices are really at a level which is unsustainable for families and for business. And we need to know what the Italian government and possibly the European Union will do to try to offset this unbelievable situation.
If you look at this far-right coalition, I was in Piazza del Popolo yesterday. We'll talk about it a little bit more later. We have, you know, three main actors in this: Giorgia Meloni, Matteo Salvini, and Silvio Berlusconi, that have ties with Donald Trump and that have ties with Putin, because this country suddenly become much more friendly towards Russia.
Well, let me say that all politicians had a tie with Putin. All Italian politicians, since the Soviet Union. So these three have ties with Putin, but Prodi has tied with Putin. Even Letta has a very good relationship with Putin, had a very good relationship with Putin, of course. Now, this has nothing to do with the supply of gas, of course.
Okay, we'll talk a lot more about that, Paolo. Thanks so much. Paolo Scaroni, chairman of AC Milan, deputy chairman of Rothschild, and of course, former Eni chief executive. He stays with us, so we'll listen actually to the UK mini-budget together, and then we'll get back to Italian politics ahead of that vote on Sunday. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Market maelstrom, yield surge, stocks sink, the dollar batters peers as central banks around the world unleash recession fears. Italy votes. We're live in Rome in what could be a historic election. We'll get, well, people vote on Sunday. We'll get results on Monday. And fiscal boost, the new UK Chancellor, Kwasi Kwarteng, is set to unveil its stimulus plans imminently. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Rome. We've been talking about, of course, energy in Europe as it pertains to Russian energy. Shortly, we'll hear also from Kwasi Kwarteng on what we should be seeing in terms of fiscal spending, tax cuts to get through the winter months. Now, I have to say it's pretty ugly. I keep on saying congratulations if you've made it to Friday, because it was a brutal week for volatility. Stocks and U.S. equity futures actually extending declines at the end of a week that really underscored through all central banks, through all the world, expectations for tighter monetary policy and a slowing global economy. Now, strategists are giving up a year and rally for European stocks. Goldman Sachs, for example, slashed its year-end target for the S&P to 3,600 from 4,300 earlier. So let's go back to Paolo Scaroni, chairman of AC Milan and deputy chairman of Rothschild. He was former Eni. Paolo, thank you so much for staying with us. We were talking before, of course, about the relationship in energy between Italy and Russia. What happens in Italian politics? So on Sunday, we cannot talk about the polls. Let's not talk about the polls, but it's widely expected that Giorgia Meloni will be prime minister. What will she be like?
Well, nobody really knows what she would be like. She has said several things. She will maintain the main position of the same position of Italy towards Russia on the Ukrainian conflict. She said that we will not make an excessive deficit. So let's say for the time being is saying very reasonable things. But in any case, you know, I'm not particularly worried because any prime minister in Italy has to face the ECB, which will decide how many Italian bonds will buy. The European Union, which will put a red light on any big change on the recovery plan. Plus NATO is not under discussion, plus the markets, of course. Yes. So in total, nothing terrible will happen.
But we could also see, and you know, what struck me in Piazza del Popolo is that the rhetoric, and I understand that this right-wing coalition wants to focus on values, right? It's the old Italy, it's quite very Trumpian. In certain cases, it's almost like Viktor Orban. So what makes the market believe that they will stick within these parameters, right, in accessing the 1.9 billion from the EU and not spending too much when we have a cost of living crisis and staying in the Eurozone?
Well, I'm sure that they will stay within these boundaries. No doubt about that. They have to do it. They said they will be doing. Of course, they will be facing big challenges, including the fact that the cost of living is going up and the cost of energy is going up quite dramatically in the country. This will be one of their challenges. The second challenge will be to find people to fill the government, particularly Meloni doesn't have a tradition of government. So where will her find the ministers, the secretaries of state, etc.? That's a big question for everyone.
So who will be finance minister?
Nobody knows. I certainly don't know. I'm wondering if she knows. In any case, she will pick among professors in university, people who got experience, somebody coming from Goldman Sachs or maybe Morgan Stanley.
It's always Goldman Sachs, right? They always end up in charge in Italy.
I said Morgan Stanley as well.
Okay, Morgan Stanley. Were you at either?
No.
Paolo, when you look at the concerns that Italians have right now, can she deliver on why she gets elected while staying within those parameters?
Yes, I think she will deliver. And I have to tell you, the fact that we make a change is positive. It's positive because this country needs some fresh air after many years in which we didn't have much fresh air. Of course, Draghi was a lot of fresh air, but was not elected. And we need to have fresh air from politics as well.
Paolo, when you see, so of course, the cost of living crisis and all of the concern, do you expect the European Central Bank to stick with Italy? I know they have this tool to intervene if there's, a widening of the spread with German bonds. What if it's something that's brought on politically?
I'm sure that the ECB will take into consideration the fact that Italy cannot be the problem for the euro. So they will do what is needed in order to keep the spread between the Italian bonds and the German bonds within a certain limit. No doubt about that. Then I'm wondering if the European Union should not make another recovery plan for the energy issues that all the Europeans are facing today.
What do you see the prescription? How would you fix it today? So we have the recovery plan. This is a lot of money. We have certain trajectory that Mario Draghi put us on. What is it's the need to grow their businesses, make sure that actually everyone is more comfortable? Because there's, if you look at GDP, it's not that bad, but it's always certain families that have it. It's really the youth that seem to be left behind all the time.
We have to go on with the Draghi agenda, no doubt about that. In particular, we have to go on because otherwise we will not get the money from the recovery plan. Yeah. And this is a very positive agenda for the country. But at the same time, we have to face the challenge of energy.
Paolo, I need to cut you off because we're also getting the UK Chancellor Kwasi Kwarteng with his mini budget. Here he is.
Their already expensive energy bills could reach as high as £6,500 next year. Mr. Speaker, we were never going to let this happen. My right honourable friend, the Prime Minister, has acted with great speed to announce one of the most significant interventions the British state has ever made. People need to know that help is coming, and help is indeed coming. We're taking 3 steps to support families and businesses with the cost of energy. Firstly, to help households, the energy price guarantee will limit the unit price that consumers pay for electricity and gas. This means that for the next 2 years, the typical annual household bill will be £2,500. For a typical household, that is a saving of at least £1,000 a year based on current prices. We are continuing our existing plans to give all households £400 off bills this winter. So taken together, Mr. Speaker, we are cutting everyone's energy bills by an expected £1,400 this year, and millions of the most vulnerable households will receive additional payments, taking their total savings this year to £2,200. Secondly, as well as helping people, we need to support the businesses who employ them. The Energy Bill Relief Scheme will reduce wholesale gas and electricity prices for all UK businesses, charities and the public sector, such as schools and hospitals. This will provide a price guarantee equivalent to the one provided for households for all businesses across the country. Thirdly, energy prices are extremely volatile, rising and falling erratically every hour. This creates real risks to energy firms who are otherwise viable businesses. Those firms help supply the essential energy needed by households and businesses. So to support the market, we are announcing the Energy Markets Financing Scheme. Delivered with the Bank of England, this scheme will provide a 100% guarantee for commercial banks to offer emergency liquidity to energy traders. Mr. Speaker, the consensus amongst independent forecasters is that the government's energy plan will reduce peak inflation by around 5 percentage points. It will reduce the cost of servicing index-linked government debt and lower wider cost of living pressures. And it will help millions of people and businesses right across the country with the cost of energy. Let no one doubt, Mr. Speaker, that during the worst energy crisis in generations, this government is on the side of the British people. The Bank of England are taking further steps to control inflation, acting again only yesterday. And I can assure the House that this government considers the Bank of England's independence to be sacrosanct. And we remain closely coordinated with the Governor and myself, speaking twice a week. But Mr. Speaker, high energy costs are not the only challenge confronting this country. Growth is not as high as it should be. This has made it harder to pay for public services, requiring taxes to rise. In turn, higher taxes on capital, higher taxes on labour have lowered returns on investment and work, reducing economic incentives and hampering growth still further. This cycle has led to the tax burden being forecast to reach the highest levels since the late 1940s, before even Her late Majesty acceded to the throne. We are determined, Mr. Speaker, to break that cycle. We need a new approach for a new era, focused on growth. Our aim over the medium term is to reach a trend rate of growth of 2.5%. And our plan, Mr. Speaker, is to expand the supply side of the economy through tax incentives and reform. That is how we will deliver higher wages, greater opportunities, and crucially, Mr. Speaker, fund public services now and into the future. That is how we will compete successfully with dynamic economies around the world. And that is how, Mr. Speaker, we will turn this vicious cycle of stagnation into a virtuous cycle of growth. So, as a government, we will focus on growth, even where that means taking difficult decisions. Now, none of this is going to happen overnight, but today we are publishing our growth plan. Today we are publishing our growth plan that sets out a new approach for this new era, built around three central priorities: reforming the supply side of the economy, maintaining a responsible approach to public finance, and cutting taxes to boost growth. Mr. Speaker, the UK today has the second lowest debt-to-GDP ratio of any G7 country. In due course, we will publish a medium-term fiscal plan setting out our responsible fiscal approach more fully, including how we plan to reduce debt as a percentage of GDP over the medium term. And the OBR, Mr. Speaker, will publish a full economic and fiscal forecast before the end of the year, with a second to follow in the new year. Fiscal responsibility remains essential for economic confidence, and it is a path we are committed to. Today, we are publishing costings of all the measures the government has taken, and those costings will be incorporated into the OBR's forecast in the usual way. The House should note that the estimated costs of our energy plans are particularly uncertain, given volatile energy prices, but based on recent prices, the total cost of the energy package for the 6 months from October is expected to be around £60 billion. We expect the cost to come down as we negotiate new long-term energy contracts with suppliers. And in the context of a global energy crisis, Mr. Speaker, it is entirely appropriate for the government to use our borrowing powers to fund temporary measures in order to support families and businesses. That's exactly what we did during the COVID-19 pandemic. A sizable intervention was right then, and it is right now. The price, the heavy price of inaction, would have been far greater than the cost of these schemes. Mr. Speaker, we are at the beginning of a new era, and as we contemplate, that's right, a new era, and as we contemplate this new era, we recognize, Mr. Speaker, that there is huge potential in our country. We have unbounded entrepreneurial drive. We have highly skilled people. We have immense global presence in sectors like finance, like life sciences, technology, and clean energy. But, Mr. Speaker, there are too many barriers for enterprise. We need a new approach to break them down, and that means reforming the supply side of our economy. Over the coming weeks, my cabinet colleagues will update the House on every aspect of our ambitious agenda. Those updates will cover the planning system, business regulations, childcare, immigration, agricultural productivity, and digital infrastructure. But, Mr. Speaker, we start this work today. An essential foundation of growth is infrastructure. The roads, railways, and networks that carry people, goods, and information all over our country. Today, our planning system for major infrastructure is too slow and fragmented. The time it takes to get consent for nationally significant projects is getting slower, not quicker, while, Mr. Speaker, our international competitors forge ahead. We have to end this. We can announce that in the coming months, we will bring forward a new bill to unpick the complex patchwork of planning restrictions and EU-derived laws that constrain our growth. We will streamline a whole host of assessments, of appraisals, of consultations, endless duplications and regulations. We will also review the government's business case process to speed up decision-making. And today, we are publishing a list of infrastructure projects that will be prioritised for acceleration in sectors like transport, energy and telecoms. And to increase housing supply and enable forthcoming planning reforms, we will also increase the disposal of surplus government land to build new homes. Mr. Speaker, we are getting out of the way to get Britain building. One of the proudest achievements of our Conservative government is that unemployment is at the lowest level for nearly 50 years. But with more vacancies than unemployed people to fill them, we need to encourage people to join the labour market. We will make work pay by reducing people's benefits if they don't fulfil their job search commitments. We will provide extra support for unemployed over 50s, and we'll ask around 120,000 more people on universal credit to take active steps to seek more and better paid work or face having their benefits reduced. Mr. Speaker, at such a critical time for our economy, it is simply unacceptable that strike action is disrupting so many lives. Other European countries have minimum service levels to stop militant trade unions closing down transport networks during strikes. So we will do the same, and we will go further. We will legislate to require unions to put pay offers to a member vote to ensure that strikes can only be called once negotiations have genuinely broken down. And of course, Mr. Speaker, to drive growth, we need new sources of capital investment. To this end, I can announce that we will accelerate reforms to the pension charge cap so that it will no longer apply to well-designed performance fees. This will unlock pension fund investments into UK assets and innovative high-growth businesses. It will benefit, Mr. Speaker, savers and increase growth. And we will provide up to £500 million to support new innovative funds and attract billions of additional pounds into UK science and technology scale-ups. Now, Mr. Speaker, this brings me to the cap on bankers' bonuses. A strong UK economy has always depended on a strong financial services sector. We need global banks to create jobs here, invest here, and pay taxes here in London, not in Paris, not in Frankfurt, and not in New York. All the bonus cap did was to push up the basic salaries of bankers or drive activity outside Europe. It never capped total remuneration. So let's not sit here and pretend otherwise. It didn't cap total remuneration. So as a consequence of this, Mr. Speaker, we are going to get rid of it. And to reaffirm, we're going to get rid of it. And to reaffirm, the UK's status as the world's financial services centre, I will set out an ambitious package of regulatory reforms later in the autumn. But, Mr. Speaker, to support growth right across the country, we need to go further with targeted action in local areas. So today, I can announce the creation of new investment zones. We will liberalise planning rules in specified agreed sites, releasing land and accelerating development. And, Mr. Speaker, we will cut taxes. For businesses in designated tax sites for 10 years, there will be accelerated tax reliefs for structures and buildings and 100% tax relief on qualifying investments in plants and machinery. On purchases of land and buildings for commercial or new residential development, there will be no stamp duty to pay whatsoever. On newly occupied business premises, there will be no business rates to pay whatsoever. And if a business hires a new employee in the tax site, then on the first £50,000 they earn, the employer will pay no national insurance whatsoever. That is an unprecedented set of tax incentives for business, Mr. Speaker, to invest, to build, and to create jobs right across the country. I can confirm to the House that we're in early discussions with nearly 40 places like Tees Valley, the West Midlands, Norfolk, and the west of England to establish investment zones. And we'll work with the developed administrations and local partners to make sure that Scotland, Wales, and Northern Ireland will also benefit if they are willing to do so. If we really want to level up, Mr. Speaker, we have to unleash the power of the private sector. And now, Mr. Speaker, we come to tax, central to solving the riddle of growth. The tax system is not simply about raising revenue for public services, vitally important though that is. Tax determines the incentives across our whole economy. And we believe that high taxes reduce incentives to work, they deter investment, and they hinder enterprise. As my right honourable friend, the Prime Minister, has said, we will review the tax system to make it simpler, more dynamic, and fairer for families, and we're taking that first step today. Mr. Speaker, the interests of businesses are not separate from the interests of individuals and families. In fact, it is businesses that employ most people in this country. It is businesses that invest in the products and services we rely on. Every additional tax on business is ultimately passed through to families through higher prices, lower pay, or lower returns on savings. So I can therefore confirm that next year's planned increase in corporation tax will be...
Well, that was the UK Chancellor, Kwasi Kwarteng. He was on fire. He wanted to make the message of they would not hurt growth. They want to deregulate, deregulate, deregulate. Of course, that headline that was pretty much expected, but that is, I'm sure, making headlines across the board is really, he wants to deliver the growth plan with large tax cuts, and he's cut banker bonuses requirements. That means that they're really trying by all their means. It's probably the biggest tax cut or tax regulation cuts that we've seen since 1988. We'll follow, of course, everything from Westminster. The pound, I know, took a little bit of a leg lower, I believe, in the last couple of minutes. Now, let's also get back to politics in Italy. The nation is in a state of political flux. Mario Draghi, who brought with him over a year of domestic stability and a friendly, familiar face for the rest of the continent, is on the way out. Italy faces a prospect of a new government, and Europe faces a prospect of a fresh relationship with the country. Well, let's now go straight to Enzo Milanesi. He's a professor at Lewis University and a former Minister of European Affairs. Thank you so much for joining us, Professor. First of all, if you look at what the UK is trying to do, deregulate to stump growth, what would you expect in terms of tax cuts, but also policies put in place by Giorgia Meloni?
Well, I think that certainly Italy would need a deregulation. It's a long-standing issue, but if the new government will be able to do that and to plan that in a careful way, it will be very positive for the country. Whether they will do it is another question, not only from the point of view, or they would like to do it, maybe, even if it's not clear from the electoral campaign, but if they will be able to do it, really to carry it on. And this is a big issue for the country. Because
Paolo Scorni was telling us basically whoever becomes the next prime minister has 3-4 walls around them. First of all, the spread, so markets will keep them in check. The EU recovery plan, they need that money, that next tranche in December, so there's parameters around that. And of course, the debt ceiling.
Yeah, clearly this is a sort of way forward which is already written, is already traced, is there. It is, I think, difficult for whatever kind of Italian government in the next future to go away from that kind of road. The question is always, and this is true for every kind of government, technocratic, as we say in this country, or political one, whether the intention will be really brought to realization. And this is the question. This is the big issue.
Do you worry, and again, there are underlying currents, of course, of Euroscepticism. I mean, if you look at the 3 people that would be part of the coalition, it's anti-immigration, it's Italy first. I know that's not what they say to the markets or with institutional international investors. Do you worry that they don't stick to those promises?
It is a risk. Indeed, it is a risk. The question is always between what you intend to do before and during an electoral campaign, before the general election, and what you are really able to do it. The coalition agreement could also be a problem, even if they have already undersigned a sort of coalition agreement for the electoral campaign. But one thing is campaigning and one thing is governing. And there, I think, there is still a question mark. But this is true for whatever kind of coalition already planned or new after the election.
Thank you. Always so clear in your thoughts. Thank you so much, Enzo Moavero Milanesi, there, professor at Lewis University, former Minister of European Affairs. Now, of course, the other show in town is what we're seeing at Westminster with the Chancellor of the Exchequer of the UK, Kwasi Kwarteng, confirming a planned increase in corporation tax cancelled. That we knew he would say, but he's just confirmed it now. He's also said that there are low tax investment zones that could be set up in almost 40 areas. He's confirmed the cap on banker bonuses will be lifted. He's also said that the government will legislate to put new conditions on unions wanting to strike. So this could possibly be the biggest force of deregulation, of detaxation since we saw since the 1980s. He is, again, saying that he's putting a growth plan with large tax cuts in place. We'll have plenty more, of course, on that. We'll see what that means for pound and the GDP for 2023 and beyond. Bloomberg Surveillance Early Edition continues in the next hour with Kriti Gupta, Katie Lyons in New York, and Anna Edwards in London. I know they'll focus on pound and also this crazy volatility that we've seen in currencies, and especially the strength in dollar. Do we need a new Plaza Accord? We'll try to discuss that next. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's been an exceptionally painful period.
There's a lot of confusion. Investors are not sure how this is going to play out.
Maybe we can get growth, but it's still going to be a tricky environment.
We're finding real opportunities. There has been carnage in this market.
We simply aren't in normal times. We are drifting towards global recession, and we are in global bear market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Central banks had a big week. It's unlikely to be the end of rate hikes aimed at crushing record inflation. The UK's mini-budget, the new government scraps a planned tax hike, puts a price on the energy bailout and removes the cap on bankers' pay. We've got analysis and market reaction. And 2 days to go before an historic election in Italy. Giorgia Meloni is seen doing well out of this and could become the country's first female prime minister. We'll look at why she makes markets edgy. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta and Kayleigh Lines in New York. Matt Miller is off today. And Chrissy and Kayleigh, we're back to those same themes, Kayleigh, around the strength of the dollar. That is certainly still front and center.
Absolutely. It's so interesting because we have seen a lot of equity action, including in Asia overnight, where stocks were down broadly. Japan was closed for a holiday, but the MSCI Asia Pacific Index ex-Japan was down more than 1%. But as you say, the story really hasn't been in equities. Instead, it's been in foreign exchange as well as in the bond market. On the subject of the bond market first, of course, we saw that monster move in treasuries yesterday, up 18 basis points on the 10-year, and you saw follow through in places like Australia and New Zealand overnight. In Australia, the 2-year yield up a whopping 25 basis points to 3.38. That is a move of more than 3 standard deviations. And then in foreign exchange, of course, the big news yesterday was intervention to stem the weakness of the Japanese yen for the first time since 1998 on the part of Japanese policymakers. That seems as though it worked yesterday. Today, though, the dollar gaining back strength against the Japanese yen, up about 0.3%. We're back up at 142.83. It echoes what we heard from our guest yesterday in that intervention only works if you have buy-in from other countries like the U.S. and if the fundamentals aren't pointing in the opposite direction, which for the Japanese yen, they are at the moment. And really for currencies across the board, as it is broad dollar strength, including the Chinese yuan, which despite the fact from the PBOC setting a stronger than expected reference rate for the 22nd day in a row, still a weaker yuan today. We're at 7.12 to the U.S. dollar, Creedy.
Yeah, Kayleigh, when you talk about that dollar strain, well, the way it reflects in U.S. assets is simply pressure on futures. Futures down about 0.6%. But I want to look at the bond market because I'm going to argue that a lot of the action is more in the bond market, the equity reaction, really a function of what you're seeing once again in treasuries. And that's why I wanted to look at the 2-year yield instead of the 10-year yield today. We're looking at 4.15 as we start to see economists broadly actually follow the lead of our very own Anna Wong with Bloomberg Economics, calling for a 5% terminal rate. As you see more and more of those calls come in, the 2-year yield getting higher and higher. 4.15, once again, another record high when it comes to 2-year yield, going all the way back to the early 2000s, up about 3 basis points earlier in the session. But as you start to see liquidity perhaps fade out a little bit, it is Friday going into the weekend. Keep an eye on that 2-year yield. How high can it go, especially with that bond market and equity market sell-off? Nevertheless, Kayleigh already covered the dollar. I won't beat it too hard, but the Bloomberg Dollar Index up about 0.5%. And once again, the reverse effects of that, Anna, is Brent crude trading with an 88 handle, down about 2%, pretty in line with the risk action that you're seeing this morning.
Yeah, absolutely. Nerves about the global economy. And this has been weeks in the making, hasn't it? This weakness we're seeing in oil prices as a result. This is the picture of weakness across European stocks today. So things worsening, actually, as we get through the European session. We're down by 1.2% in the London market. The CAC 40 and the Xetra DAX both down by around 0.9. of 1%. We've been dealing with a lot of new information, a lot of new headlines coming through from Westminster, from the new UK government. They've been talking about what they want to do on the fiscal side of things, a mini budget being announced by the Chancellor. And so I put the pound in my graphic to show you, 111.92, down by 0.6%. Interesting, just in the last few minutes, we've seen some new information about the amount of borrowing, gilt issuance the government wants to do. We seem to be seeing more tax cuts coming through than even had been expected. And we did just witness a big spike up in the 10-year gilt yield. So we'll keep an eye on those. But this is the pound reaction that we're seeing at this point. The euro is under pressure today, down by 0.7%. So when we're thinking about where that dollar strength is being conducted, certainly against the euro, 0.97. We've gone to levels we haven't seen since 2002 on the single currency. Brent crude, Critty's already mentioned, and Credit Suisse I put in. They denied reports by other media about what they are planning to do in their strategic review. But just to underline, we're seeing an all-time low in this share price. Despite that denial, a lot of uncertainty about the strategy at the business, and we wait for another few weeks, it seems, until we get further details. That stock down by 5.8% today. Let's focus in on what we've been hearing from Westminster. Let's get to Westminster. The UK Chancellor, Kwasi Kwarteng, has just been speaking, is still speaking, I think. No, just finished, and now we get a reply from the opposition. Has been making that announcement about the government's economic growth plan in Parliament. Bloomberg's Lizzie Burden joins us now with more. Lizzie, I was taken by the movement we've just seen in gilt yields. What stood out to you?
Well, it felt like a full budget, even if it's not called one. And Kwarteng started by confirming the energy support that's already been announced. The energy crisis, of course, at the heart of the cost of living crisis. But then he moved on to the tax cuts that we'd been expecting. So this was really Kwarteng showing that the Truss government is true conservative, as they'd like to put it, despite the energy bailouts, and putting the new government's stamp on the economy. So he said there are going to be more updates in the coming weeks, but what we've learned is they're lifting the bankers' bonus cap, they're scrapping the planned corporation tax rise. That's, he says, going to plough £19 billion back into the economy a year. He reversed the payroll tax rise. He raised house property transaction tax thresholds. There's an income tax cut brought forward, and he scrapped planned alcohol duty rises. So lots of tax cuts here. A big focus on growth. That's the message that Kwarteng wants to convey, but there could be a bit of a hangover.
Lizzie, a key theme that's emerging around the world is this divergence between what the monetary authorities are doing, what the fiscal authorities are doing. How is the government going to afford all of this? Any color on that?
Yeah, what we've learned is the UK is planning almost £200 of gilt sales this fiscal year. Kwarteng says that the full costings are going to come out later, but he anticipates that it'll cost £60 billion for the energy package in its first 6 months, though he expects that to come down as they negotiate with suppliers. But crucially, this mini-budget fiscal event, whatever you want to call it, is not accompanied by a forecast from the official fiscal watchdog, the Office for Budget Responsibility. We had the chairman of the Treasury Select Committee, Mel Stride, on earlier. He had called for that to happen, but Kwarteng says no. So the vagueness continues, and lots of economists have raised their concerns about how much these measures will add to inflation, whether they'll actually boost growth much, and, as you say, the borrowing that this is going to entail.
All right, Bloomberg's Lizzie Burden, thank you so much for joining us on that breaking news. Massive reaction in the bond market, as Anna said. The 10-year UK gilt yield up 16 basis points right now. The 2-year up by 21 basis points. It's been a wild week, including a blitz of interest rate hikes, and it's unlikely to mark the end of a campaign by central banks to crush inflation. Investors fearing that these hawkish central banks, including the Fed, will drive economies into recession. Former Goldman Sachs strategist Abby Joseph Cohn spoke on Bloomberg about that dilemma facing investors.
I think we're now at a point where, given the significant rises in interest rates and yields across the yield curve since the beginning of the year, the equity market is now focused much less on inflation and yields than it is on earnings.
Bloomberg's Danny Berger joins us now for more. And Danny, Goldman out saying maybe things are going to be worse than we thought.
Yeah, look, I mean, Goldman is kind of behind. They're kind of playing catch up on this. Jan Hatzius, after the central bank decision from the Fed, upgraded his view of 75 basis points next month from the Fed before they saw 50. So the equity team over at Goldman needs to play catch up too. And look, I don't mean that as just a dig at Goldman. Everybody is playing catch up with the Fed right now, considering that those dots were a surprise to many folks out there. Now, Goldman, their call for year end is 3,600. They are specifically saying, look at what real yields have done. We've seen for radio listing audience, I have a chart of the price to equity ratio for the S&P and 10-year real yields. It is inverted, but basically to show that these things usually track each other, because when yields are going higher, when the discount rate is going higher, you have to discount future cash flows. So in theory, the S&P 500 needs to play catch up with this huge surge we have seen in the real yield. And look, equity investors, they're behind. They have to not just focus on inflation anymore, but what this current environment and rate hikes mean for earnings. So perhaps we haven't fully digested it, where, as you pointed out, Kaylee, the rest of the market, I mean, what a week of digestion it has been. Continue to see record strength in the dollar, the longest run of gains for the U.S. two-year yield in 3 decades. I mean, the UK two-year yield, which I also have on my board for our radio listening audience, of course, acting kind of crazy at the moment because of what we're hearing from Kwasi Kwarteng, but it is a global reaction. Again, Kriti, it's just equity investors really need to play a game of catch up right now.
That seems to be a global story. Bloomberg's Danny Berger, thank you as always for walking us through it. Let's go from the equity market to, well, Italy. Italy goes to the polls this weekend, bringing fresh uncertainty for investors, already fretting over rising interest rates and energy crunch and a potential recession. Bloomberg's Francine Lacqua joins us now from Rome. I'm pretty sure she was in New York 48 hours ago. Francine, how are we set up going into this election?
Yeah, thank you, BA. And then I have, of course, not the jet lag, but the time difference on my side. Pretty, if you look at the polls, we can't talk about them, but it's pretty clear that we'll get some kind of right-wing coalition with a majority making, Giorgia Meloni prime minister. Now, everything could change, but actually, given where we are, that's very likely. Now, she has tried to reassure the markets as much as she can in saying, look, I will stick to the plan put by Mario Draghi. We want those 1.9 billion euros that the EU will disburse, of course, in December. If they stick to the plan, they won't spend too much and they'll pretty much please the markets. But there is a bit of uneasiness because there's a lot that the market is questioning. She is a Eurosceptic by nature. She has not said anything bad about the Eurozone so far. But what if, once she comes into power, depending on the coalition partners, she becomes the Giorgia Meloni we knew 3-4 years ago? And that's the main risk out here.
Right, and that's what the markets are focused on then, Fran, the relationship with the EU and what that does to the amount of money Italy can get.
Yeah, I think they're focusing, hi Anna, on 4 things. So first of all, the relationship with Russia, whether we're going to see, of course, a breakaway from what Mario Draghi was saying on Ukraine. Remember, he famously said we have to choose between peace and air conditioning. What happens with this new government if we get into very cold months? They need to, of course, also look at the fiscal plans. So this is the debt. Italy has one of the highest debt in the Eurozone. We mentioned what the plan is for the recovery fund, but that means that they have to stick with 55 points that Mario Draghi has promised. And the other 4th question is that if there were to be a spread, a widening of the spread between Italian BTPs and German bonds, does the ECB then activate their tool if it's because of political concern in Italy? And that, I have to say, is one of the toughest questions to answer right now.
All right, Bloomberg's Francine Lacqua reporting from a beautiful Rome. Looking forward to your coverage throughout the weekend here on Bloomberg. Now to another company story we are watching this morning, FedEx. Cutting flights, deferring projects, and closing offices as it seeks to save as much as $2.1 billion to tackle challenges, including slowing demand and a tight labor market. The company reported first quarter earnings after the bell, after last week suffering its worst one-day decline in more than 40 years after it flagged worsening macroeconomic conditions. As for how that's translating into the stock in pre-market trading, it is not yet trading before the bell, but definitely one to watch as that opens up. And of course, when the start of trading begins here in the U.S. in about 4 hours and 17 minutes time or so, Anna.
Okay, FedEx not delivering any pre-market excitement then. Let's focus on what's coming up later in the program. We'll get a take on the markets. Max Kettner joins us, Chief Multi-Asset Strategist at HSBC. We talked about how other banks have been bringing down expectations for stocks. What does the higher yield environment mean to Max? We'll get his view. This is Bloomberg.
should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. Now, we got to talk about the currency market. I always love to do it. It's a pity Matt isn't here. He'd be making fun of me for it. But yesterday's story in the Japanese yen was crucial. The first intervention to support the yen going all the way back to 1998. For our radio audience, that's the chart that I'm showing here. We're seeing that intervention, like I said, going all the way back to 1998 to support the yen. But of course, the BOJ has a massive history of helping the yen in the other direction. Here's what's crucial, though, and here's going to be the major question. As we talk about interest rate differentials really driving the trade in the FX market, perhaps from as a result of these central banks, how sustainable is the concept of intervention? The idea that this is a market that trades $4 trillion a day. Back in 1998, the last time they did this, they had the support of the U.S. Treasury, the European authorities. It was a global coordinated effort. This time around, it is done one-handedly, single-handedly, I should say. So the question here is, the BOJ is not alone. The BOE suffering the same thing as you see the pound really weaken. The euro, of course, we know having that parity conversation, perhaps going even lower. Can anything really be done on the central bank front? Let's ask our Bloomberg Markets editor, Lynn Thomason, who, of course, has been watching all things macro, but specifically the currency market. Lynn, what do you do when a currency has no support?
Oof, yeah, I mean, I think you really worry about where it's going to go. I mean, I think the interesting thing about the yen is that it's really sort of stood out, you know, with the BOJ as the one central bank out there that hasn't raised rates. And you sort of wonder, I mean, like the intervention you said, it can only be a temporary measure. It can't be something that lasts forever.
Yes, indeed. And let me talk about something else that's been moving a lot, and that is UK gilt yield. So this definitely very much a story of the moment, because we're still watching what's happening here. We've got up to 3.63 on the 10-year UK gilt yield. I mean, we entered this year, Lynn, with a yield much lower than this. 10-year gilt yield started this year below 1%. I know that's a global story, but things moving pretty quickly this morning on the UK story. What have we added to our knowledge? Obviously, we've got a package of measures to work through.
Yeah, absolutely. I mean, I think you can sort of really think of the UK as like, it's part of the global story, but it's everything to the extreme. I mean, the moves in gilt yields are huge. The pound is also taking a big loss. And you're seeing, I think, what everyone was worried about in the mini budget. I mean, there's really nothing mini about it in the budget that came out today. You know, that the government is coming forth with this aggressive spending plan, really trying to cut taxes and accelerate growth. But I think a lot of people are worried that it's just going to accelerate the inflation picture.
Right, and that is the government's point. They talk about this is going to be going for growth. They want 2.5% growth rate every year. That's what they try to do, supply side reforms in the future and the like. But in the short term, does it seem as if gilt markets are focused on a bit of a lack of information because there is no OBR, Office of Budget Responsibility, forecasting to go along with this, as Lizzie was telling us a little bit earlier on, which is not usual. Perhaps it's usual in an emergency, fine, but this is not necessarily such a mini budget.
Yeah, I think that's the final takeaway. And I think, also, investors are worried about how this is going to play into long-term borrowing costs, and that's being reflected in the gilt yields. That you're seeing those rise up just so much more than the rest of the world really speaks to the fear, I think, and anxiety that people have about the UK market right now.
Speaking of fear and anxiety, you definitely have seen a certain amount of that reflected in the equity markets here in the U.S., especially, Lynn. We've had Goldman Sachs now cutting their year-end S&P target down to 3,600. You're seeing strategists in Europe as well starting to pull back on their expectations for how well the European markets can do by the end of this year. Dare I say capitulation?
I think that's starting to come into the picture, especially with strategists tend to be a bullish group. They always tend to be forecasting gains. And I think when you've got strategists now cutting forecasts en masse, it really speaks to the level of pessimism and worry that's in this market right now. And I think, a lot of people are saying it's not going to turn around anytime soon.
It's certainly not turning around in the futures picture, is it? It looks pretty red on the screen there. Lynn, thank you very much for that. Bloomberg's Lynn Thomason joining us with the latest on these markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. The European Union is rushing to agree on a price cap on Russian oil within weeks. Bloomberg's learned the cap will likely be part of a new package of sanctions that will be proposed by the European Commission. A cap would put the EU on the same page with the U.S. and would hit Moscow's revenue. Boeing has agreed to pay $200 million to settle an SEC investigation into 737 MAX safety issues. Former CEO Dennis Muhlenberg will pay $1 million as part of the agreement. Regulators say Boeing and he failed to disclose problems with the 737 MAX, which was involved in 2 fatal crashes. The special master in the Trump documents case has ordered the former president's lawyers to state in a court filing whether they believe the FBI is lying about the papers. In effect, Judge Raymond Dearie is demanding that Donald Trump's lawyers back up his claims. The former president has said the FBI planted items during the search of his Florida home. And in sports, the NBA's Boston Celtics have suspended head coach Ime Udoka for the entire season for violating team policies. According to the Associated Press, Udoka had an improper relationship with a member of the organization. Last season, his first as a head coach, he led the Celtics to the NBA Finals. The team's one of the favorites to win the title this season, though I would imagine, Anna, that the odds of that and the way that it is priced in the sports betting market have likely changed as a result of this suspension. That's something I track on my sports betting show, which airs on the weekends. But here on Surveillance Early Edition, there's market stories we are tracking as well, including the headlines out of the UK.
Yes, but I like how you managed to turn that sports story in to a little promotional material for your other show. This is very, very professionally done, Kaylee. Let's get back to what's happening in the UK, as you say, other headlines to focus on. A quick recap on what we've heard from the UK then. Kwasi Kwarteng, the Chancellor, putting a price on the energy bill bailout, saying he's scrapping the cap on bankers' bonuses and cutting some taxes or not going ahead with increases in taxes in the way that had been assumed. And the market responds to this, Kriti, most notably with a rise in gilt yields.
Yeah, we're looking at about a 17 basis point move on the 10-year gilt. What I think is interesting, though, is how quickly it's happening. As follows yesterday, also a 17 basis point move, Anna. It is a ripple effect that's going across the world.
Yeah. And there is Kwasi Kwarteng still taking questions in the House of Commons here in London. Up next, we'll ask about this. We will talk about this, rather, with Max Kettner, who joins us from HSBC. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Central banks, it's a big week. It's unlikely to be the end of rate hikes aimed at crushing record inflation. The UK's mini budget, the new government scraps a planned tax hike, puts a price on the energy bailout and removes the cap on bankers' pay. We have analysis and market reaction. And 2 days to go before an historic election in Italy, with Giorgia Meloni vying to become the country's first female prime minister. We will look at why she makes markets edgy. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lyons in New York. Matt Miller is off today. And Chrissy, a lot of focus here in the UK on what's going on in FX markets, on what's happening in gilt markets. So run us up to the start of trade over in the US with what's happening in equity markets.
Yeah, well, it's a little bit of a ripple effect, Anna. When you see any kind of major movement in any sovereign bond market, of course, is going to have some sort of effect into U.S. Treasuries as well. And that's exactly what you're seeing. The two-year yield climbing higher and higher, perhaps by a smaller margin. We're only about 4 basis points in the early trading, in the U.S. early trading, I should say. But the two-year yield still at 416 basis points. As we start talking about a terminal rate that could potentially be at 5%, our own Anna Wong ahead of the call on that. The two-year yield is going to creep up higher and higher. The ripple effect of that is going to show up in the dollar, and that's where you're seeing the strength of about 0.6%, in addition to it reacting to, of course, what's happening in the UK, the weakness in the pound driving the dollar higher, and then the ripple effect of that, one more domino effect, Kaylee, is, of course, what you're seeing not only in Brent crude in the commodity space, an 88 handle on Brent crude, about down 1.8%, but also what's happening in futures, which brings us right back up to the top of the board here for our TV audience. Futures down 0.7%, and really, it does look like a cross-asset story.
Yeah, well, you mentioned Brent. I would note it's really weakness across the commodity complex because copper is also down about 3% today. So as a result, any commodity-sensitive equities in early hours aren't doing so well. The likes of Freeport-McMoRan, Cleveland-Cliffs, or Cliffs Natural Resources down 3.8% and 1.5% respectively. And then in the oil space, a lot of those energy players seeing some weakness today as well. Occidental Petroleum down 1.8% or so, as is Devon Energy. So a lot of weakness you were seeing in the energy and materials sectors this morning, Anna.
Yeah, absolutely, and that's reflected here in Europe, Kaylee. For much of this morning, we've seen weakness in energy names, basic resources. Overall, the stocks in Europe, a weaker picture, down by 1.2%. As the morning has gone on through the last 2.5 hours, things have got worse, really, for European stocks. Here's a couple of UK assets to focus on, as we've heard from the new UK Chancellor, Kwasi Kwarteng, delivering his so-called mini-budget, but there were a lot of news lines in there. This is the impact we've had on the markets. We'll go to the 10-year yield first. This was at 3.5% before he started speaking. 3.7 is where we are right now. It seems as if taxes are either not going up or are coming down more than had been anticipated. We knew that would be the direction of travel, but there's a little bit more in there maybe. A lot of uncertainty as well about what this does to the UK economy. Does it deliver the growth that the government wants to achieve here, or does it just build up debt? And that is something that the markets might be a little bit nervous about, especially as we don't have a forecast here from the OBR, something that market participants are used to. This is the pound response. So it was down by more than this, pared those losses just a little bit, 111.95, still a weak picture then for the pound relative to recent history. And Brent crude, Chrissy has been through that one, down by 1.9% this morning then, Chrissy.
A lot of pain in the markets. It feels like there's no real place to hide except the US dollar, a consensus trade that a lot of people are already saying is a little bit overcrowded. Speaking of all the bad news in the markets, who better to bring in than Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, thank you as always for joining us. Is there any good news out there?
I'm afraid not really right now, right? I guess the only good news that I could provide is that at some point, perhaps sentiment and positioning will become so extremely bearish, and at some point, no one's really going to find any kind of positive news and any kind of reason to buy risk assets, and perhaps that is exactly the reason why you want to buy risk assets then. The issue with that is that when we look at our aggregate sentiment and positioning indicator, for example, it's still around sort of the 25th percentile. And just to give you a comparison, in the middle of June, when we had this downdraft in risk assets as well, we were down on sort of the 8th and 9th percentile. So unfortunately, even from a sentiment and from a positioning perspective, even there's a bit of ways to go still. And from a fundamental perspective, I think the big issue is we have this lose-lose situation. We have this situation that we described as sort of tails you win and heads I lose kind of situation.
Okay, and bringing that to the UK, Max, very good to see you here in the studio here in London. We've heard a lot about the fiscal package this morning from Kwasi Kwarteng, the Chancellor, and it does seem as if the market is now a bit nervous. When you look at what the response has been in gilts yields have spiked considerably higher this morning. We're going to see quite a lot of issuance, whether that's borrowing by the government or quantitative tightening by the Bank of England, not issuance rather, but gilts coming to the market.
Yeah, I guess the big issue is that net supply could really spike quite a bit, right, going into 2023. So we could end up in a situation where net supply is rising to a new record high. Now, with the UK's basic balance being so really challenged, that is not good news for the pound, right? It's not good news for the pound. It's not good news for gilts. Now, funnily enough, that doesn't really apply to the UK equity market. It does apply to the FTSE 250, right?
Yeah.
It does apply to small and mid caps. To the FTSE 100, much lesser, right? Because it's much more international, so you get the sort of defensive value from that.
So maybe not too much of an issue for UK stocks for the reasons you mentioned, them being international, but does it add up to some sort of funding crisis for gilt markets, or are we not quite there yet, Max?
I don't think we're quite there yet for a funding crisis. Let's bear in mind, right? If we look a month and a half ago, we had 10-year Treasury yields at 2.5. Now we're almost up to 4, right? A month and a half later. And I don't think, for example, for Treasuries, we would speak about a funding crisis either, right? Now, gilts, of course, have been the underperformer. It reacts to this sort of fundamentally more challenged situation in the UK. But I would still say, relative to the others, relative to bunds, relative to Treasuries, it's actually still pretty orderly, right? Actually, when we look at it, not only the UK, look at BTPs, right? We heard from you before that, the market is very, very worried about Italian elections. Actually, when we look at BTP bund spreads, right, they're sort of grinding around 220, 230 basis points. So it's sort of a slow, a very, very ever so slow grind wider, but it's not really a panic situation yet.
Okay. Max, I want to go back to your idea that heads you win, tails I lose, kind of the idea being that either outcome you look at, whether it's that the data holds up, so central banks have to be even more aggressive, that turns out to be bad for equities, or the data deteriorates, there's growth concern, that also is bad for equities. But I'm wondering if there's some nuance we can find there in that outcome A, it's higher rates putting pressure on valuations, maybe more bad for growth stocks. Option B, maybe more bad for cyclical stocks. Which do you think is more likely, and how does that affect where within equities, even though I know you are underweight, you'd want to be shifted towards?
Yeah, I think so exactly how you described, right? We have this most miserable of all situations where whatever happens, right? If activity data surprises to the upside, we're still going to get more from central banks, so valuation will be challenged. In that scenario, that is actually the much more challenging scenario. And I think for now, that is the more likely scenario still. So from an asset allocation perspective, it's much more challenging than the second scenario that we've got, the classic risk-off scenario, because in that scenario, well, what do? You buy duration, you buy defensives, you buy growth over value, you buy investment-grade credit over high yield. It's a classic risk-off scenario that we're used to from an asset allocation perspective. However, the first scenario is the much more challenging one because it means you can't really buy duration yet. That means that growth is also going to be challenged more than value. But given that growth is such a big part of the equity market, right? Such a big heavyweight from a market cap perspective, that means it's going to challenge equities. By extension, it also challenges high yield. And the only place really to hide out is long dollar cash, long sort of front-end assets. So floating rate notes, short-dated investment-grade credit, right? And above all, really still the dollar and still dollar cash.
Well, on the cash point, Bank of America publishing this morning, noting that in the week through Wednesday, cash had inflows of $30.3 billion. Max, what do you need to see? At what point is it time to deploy some of that cash, to wade back in? How long do you wait? What do you wait for?
I think, first we've got to figure out which regime are we going back to? Are we going into a risk-off, right, into that classic risk-off regime? So are markets at some point going to be scared no longer about inflation so much, but much more scared about growth? I do think that's the most likely scenario. So the most likely move is going and switching back from cash into sovereign bonds into duration, right? Once those growth concerns really take over. That, however, is probably going to take some time, right? There is a certain lead-lag relationship between mortgage rates, housing data, and then housing data and the unemployment rate. So it probably will take sort of another quarter, 2 quarters until we can do that. That is sort of the signs that I'm watching, perhaps housing market, how that really feeds through into the labor market. In reality, look at yesterday's claims data. We're really clearly not yet at that point where that is feeding through into these worse than expected growth data that we have to watch out for.
Okay, Max, thanks very much for joining us. Max Kettner, Chief Multi-Asset Strategist at HSBC. Coming up on the program, we'll talk about crypto. The bear market comes for crypto executives. We'll discuss the recent spate of CEO departures and what is ahead in the world of digital assets. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I'm excited for this next chapter. I'm extremely confident in David Ripley and his ability to lead this company. You know, he's been with us since we were 50 people 6 years ago, all the way up to, mid 3,000s right now. So, he's seen it all, and I'm just super glad that we have such a deep bench and someone able to step up from the inside.
Jesse Powell of the crypto exchange Kraken speaking with Bloomberg earlier this week after announcing he will be stepping down as CEO to be replaced by COO David Ripley. His resignation is the latest in a string of crypto CEOs that are moving away from running their companies. The raft of succession sets the stage for a changing of the guard in the roughly decade-old industry. Dmitry Tokarev, CEO of Copper, a platform designed to make cryptocurrency acquisition and safe storage easier for institutional investors, joins us now. Dmitry, before we get to the specifics of your business, if I could just ask you the succession question. We have seen this wave of executives moving away, seems to be signaling something about the toll it takes to be running a business in this volatile industry. How much do you feel that, and what does Copper's own succession plan look like?
Well, it's not surprising. Generally speaking, we see decentralized finance merging with traditional finance more and more and more, and same rules that we see in financial markets start applying in crypto markets. Generally, the move, I think it's a good move for Kraken, and you know, generally speaking, for Copper, we don't have such plans at the moment, but we are enhancing our executive team with more and more team members from traditional finance.
Okay. Good morning, Dimitri. Good to see you here in London. Let me ask you about you clearly work at that relationship between the crypto world and the more sort of institutional asset world. What appetite do those businesses have for crypto at this point and for blockchain, given the crypto winter that we're in? Have you seen a marked deterioration of interest given what's been happening?
Well, if we take a more of a bird's eye view on what's happening generally, because those are two separate things. The cryptocurrency is one thing, and different, you know, analysts we can tell, you know, whether Bitcoin is going to go up or down, etc. If we talk about largely blockchain technology and what's happening there, this is not a party you want to be late for. This is absolutely massive reformation that we're looking at here. We have several centers of excellence in the world, right, where people know how to operate financial markets. New York, London, et cetera, but there aren't that many. Blockchain removes that requirement. With blockchain, you can operate same volumes, but with 20 to 50 times less people.
Right, but so during the crypto winter, and I take what your point about, you know, you don't necessarily want to talk about or know whether whether Bitcoin goes up tomorrow or down tomorrow. But has there been, but it is associated in the minds of many with, of course, the infrastructure, and blockchain is that. So do you see a reduced interest in blockchain, or no? Do institutional executives know enough to separate the two?
We don't see a reduced interest in blockchain. If anything, we have an increased interest in blockchain technology.
Really, despite the winter?
100%, 100%. But this is like email and internet, right? We're talking about 1995, whether people are still interested in email, etc. The larger play here is internet, which is blockchain.
Right.
Dimitri, if we can talk about the market angle here, of course, we know central banks and the news coming out of them around the world are all the rage right now. Bitcoin very tied to what you're seeing coming out of the mouth of Jerome Powell and his colleagues around the world. Your take on whether Bitcoin is actually becoming a mainstream asset when it comes to more macro events like rate decisions?
As I mentioned previously, I don't think this is generally important for blockchain technology as a whole. So Bitcoin is a completely beast on its own. This is one application of blockchain technology. There is a sentiment around Wall Street from buy side and sell side that we are seeing of all securities migrating to blockchain technology. This is completely independent from Bitcoin.
So Dimitri, where does crypto broadly then, as an entire asset class, for example, really take its cue from? If you're looking at it from a macro basis, does it looking for technology stocks? Is it looking at rates, other commodities, even the dollar maybe? Does it take its cue from any other cross-asset relationships?
From all of them. This is a completely new realm, essentially, but you will see linkages across all asset classes to crypto. It's not that you can't pick single-handedly one of them and say, hey, by the way, this looks like a commodity, you know, and everything looks like a commodity. It would be one would look like a commodity, another one would look more like equity, another one would look like hobbies on its own.
Dimitri, thank you very much for your time. Talk about Bitcoin and the world of blockchain, more specifically around your business, of course. Dimitri Tokarev, the CEO of Copper, thank you very much for joining us. Let me just get to some breaking news that we have across the Bloomberg terminal, and this is in connection with what's being announced by the Chancellor, the UK Chancellor, today in Westminster. The UK 5-year yield has jumped 50 basis points. It's set for its biggest rise on record. We've been watching these yields rise. I focused on the 10-year earlier, but the 5-year having this substantial gain, set for its biggest rise on record. Traders put a 50% odds on a 100 basis point Bank of England rate hike in November. They'd previously been suspecting 50 or 75, but now we seem to have a 50% chance of a 100 basis point hike from the Bank of England. The BOE saying through, I think it was Jonathan Haskell saying just last night how difficult this fiscal package makes the job of the Bank of England. Our thanks to the CEO of Copper for that conversation around crypto. That's the latest on the markets. We'll be back with more on the reopening of Hong Kong shortly. This is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Kaylee Lyons joining Lisa Bromwitz and Damian Sassower in just a few moments for the next hour on Bloomberg Surveillance. Let's take a look at what we should be watching in the day ahead. We're going to get U.S. PMI data at 9:45 a.m. New York time. And of course, across the Atlantic, the UK Parliament goes on recess this evening ahead of Labour Party and Conservatives Party's conferences. And of course, Fed Chair Jerome Powell will make opening remarks at a Fed Listens event hosted at the board in Washington at 2 p.m. New York time. Anna, a lot to digest, and it's only, well, not even 6 a.m. here in New York.
Yeah. 5:51, I think, for you. So, yeah, it's early. Meanwhile, over in Hong Kong, it's a lot later than that, and Hong Kong is scrapping hotel quarantine for inbound travelers from next week. The most substantial move yet in the city's push to end its isolation. John Lee, Hong Kong's chief executive, spoke earlier.
We also want to ensure that as we progress, we can do it in an orderly manner. By introducing this new measure of 0+3, obviously, this is a kind of relaxation from the 3+4. So we want to ensure that we will monitor the situation closely so that all the risks are well controlled.
Rachel Chang joins us, our Asia Healthcare and Consumer Editor in Hong Kong. And for many people who live in Hong Kong, Rachel, this must be another sigh of relief. Earlier on this week, there was talk of loosening of various regulations. How significant is today's move?
Indeed, I think for all of us who live in Hong Kong, it's the end of a 2-year nightmare, to be honest. I mean, cannot overstate how hated this hotel quarantine system was. Hotel quarantine. At some point last year, you had to spend 21 days in a hotel room just to get back to Hong Kong. It's been a massive reason why so many expatriates and talent have left the city to go elsewhere. And so, it's a really long-awaited move and a long-anticipated move. And for residents in Hong Kong, it's a big move to allow them to travel freely again. However, Hong Kong is still so far away from what the rest of the world are doing. So with the scrap of hotel quarantine, visitors will still have to spend 3 days sort of monitoring their health at home. They can move around, but they cannot enter restaurants and bars or places where their masks are going to be removed. They still have to do PCR testing almost every day. This is extremely different from the situation in Singapore, in London, in the US, everywhere around the world. So, that gap between Hong Kong and the rest of the world does still remain.
Well, Rachel, it's no secret that China isn't looking to change their zero-COVID policy anytime soon. What are the odds here that this gets reversed, that we actually see more quarantine times in the future, especially at perhaps peak exposure to the virus in the winter, for example?
So I think thankfully for Hong Kong, they've said many times there's no going back. Hong Kong is moving in the reopening direction. China, of course, taking a really different pathway. And what we know is that the border between Hong Kong and China, that remains. People from Hong Kong have to do 7 days hotel quarantine to get into the mainland, just like from any other place in the world. So, China is still putting up its fences to block people from bringing the virus in from Hong Kong. What we do know is that it's quite clear now that Hong Kong as a city, if it wants to maintain its global financial status, if it wants to remain a gateway for people from the rest of the world into China, it has to take down these restrictions because it has to be closer to these rival financial hubs that are right now, attracting all the business, attracting all the talent, and making Hong Kong no longer a place to be if you want to do business.
Rachel, thank you very much. Bloomberg's Rachel Chang in Hong Kong with the latest on a changing regulatory picture around COVID, dealing with something very post-COVID here in the UK, and that is all around inflation, of course. The inflation fight, the story of yesterday with the Bank of England. Today was the fiscal fight, and we heard from the Chancellor. A lot of announcements coming through from the Chancellor, a lot of detail to be worked through, putting a price on the energy bailout. It's having a significant effect on assets. We've seen a surge higher in gilt yields. We mentioned the 5-year gilt yield a moment ago. 10-year yields also surging. The biggest jump on record in the 5-year yield. The pound very much under pressure. Critty, we saw it drop down to a 110 handle on the pound before it just recovered up to 111, as you see there. It's still down 1.4% though, Critty, on the day. The strong dollar, of course, has been damaging in a sense to many economies around the world, but this is driven by domestic policy here in the UK.
It absolutely is. It's really a poster child for the issue you're seeing around the world, this drift, this divergence between a monetary authority and the fiscal authority. If you're looking at the gilts, by the way, the 10-year gilt, a 30 basis point move in just the 10-year yield. Anna, that has changed in just the last 20 minutes. A flatter gilt curve, of course, a consequence of that.
Yeah. And the odds of a 100 basis point hike in November now stand at 92%, and that is failing to support the pound, which is very interesting for FX markets and what drives them. Thanks very much for watching this early edition of Bloomberg Surveillance. More surveillance still ahead, of course. They'll continue to focus on what's going on in the UK assets because there is so much movement. Some spillover. We are seeing higher yields in other jurisdictions as well, so no doubt more on bond markets globally. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every central bank is competing with every other to bring inflation down quickly.
There's a lot of confusion. Investors are not sure how this is going to play out.
We're finding real opportunities. There has been carnage in this market.
It's all about the rate of change, and I think that's what really central banks would react to.
The government's really taking a gamble here that the policies that it's implementing are going to do something to boost growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A messy end to a messy week. Welcome back. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. My partners in crime, Tom Keene and Jonathan Farrow, are off watching reruns of Ted Lasso together, which is great for us because we have Kaylee Lyons and Damian Sassower in the seat. It feels like something is breaking, a sea change, Kaylee, in markets.
I love the way our colleague John Authors put it in his column in Bloomberg Opinion this morning. This was a week that shook the world. Each and every day, some kind of market fiasco seems to have happened in terms of pricing and assets. In foreign exchange, in bonds, of course, we have seen intervention to stem the weakness in the Japanese yen for the first time since 1998. We've seen the Fed saying we're going to go farther and stay higher for longer than the market previously anticipated. And after a 50 basis point hike from the BOE yesterday, this market now pricing in a 50% chance they go 100 next time around because of the fiscal policies we've had announced in the UK this morning, Lisa.
And Damian, in your world is driving so much of this. People looking for something to break, particularly in the developing world as the dollar continues to strengthen. Are things starting to break?
Well, I mean, if you're including Japan in my world, which I don't believe you are, well then, yeah, sure, things are breaking. I mean, look, you know, the money has to come from somewhere, right? You don't see the Bank of Japan hitting the Fed swap lines. Are they selling treasuries in order to fund their intervention policy? That remains to be seen. But if yesterday's price action's any indication, yeah, you know, I bet you had some central banks out there selling treasuries to raise assets to protect their currencies, Lisa.
All right, when we talk about currencies, and Kaylee, I know you've been on top of this. We've been looking at which currency pairs are really breaking down, and today, very much front and center, the pound. It's been breaking down for the past few weeks, but now we're down to 111. And this is just raising a lot of questions and comes as this administration of Liz Truss announces the biggest tax cuts going back to 1973. Does it feel controlled? I mean, what are you hearing this morning?
I don't think it feels particularly controlled because this is also a case of monetary and fiscal policy running against each other in some sense, because she's talking about tax cuts at the same time that they are attempting to boost spending to stem the energy crisis. They say that's going to cost about 60 billion pounds. They have to issue debt to do that. So what you're seeing is huge moves in gilts. We've at one point on the day up 50 basis points on the day on the 5-year gilt yield, and the pound, as you allude to, Lisa, we had a breach of 111 at one point. The lows of the day 110.77. These are levels we haven't seen since 1985, and it is a sense of there's not much that policymakers can do to stem the losses in those currencies unless you see something akin to the 80s in a Plaza Accord.
So before we get to the price action, Damian, I know you've been in this market for decades, and I'd love your perspective on what the analogy is, what the conversations among the traders you speak to are like, what the level of concern, of fear, of potential opportunity and excitement there is.
Well, I mean, for me, look, I mean, I've long been on the record here as saying I think intervention's a bygone conclusion. There will need to be intervention at some point, whether it's unilateral or there's some sort of coordinated Plaza type accord remains to be seen. I mean, I think the only thing, quite frankly, holding back sort of a coordinated intervention, so to speak, is the fact that a stronger dollar is bad for China. And so, you know, the U.S. has no intention, I think, of, you know, basically weakening it intentionally because of that fact. And so, look, Europe and England and the rest are really going to have to deal with that in the current environment.
Right now, we're looking at losses pretty much across the board, and I want to get a sense, and Kaylee, you know, jump in here with what you're seeing, but what I'm seeing is an S&P that is down nearly 12%, actually going toward 13%. So far, right now, you are seeing it continue the losses. That's just on the week, of the past couple of weeks. Right now, down 0.8%, and you can see the NASDAQ down 1%. It just has been this grind in particularly the big tech stocks, some of the most high high flyers from earlier in the pandemic.
It's valuation pressure in the face of higher rates and, more importantly, higher real yields. That is the very reason why we had David Kostin over at Goldman Sachs saying, hey, I'm cutting my S&P target down to 3,600 because of that valuation question.
And when you take a look at some of the yields, you're just seeing yields stabilize here, but just after coming off such incredible highs. I mean, I was just looking, for example, at 2-year yields, and since mid-August, they have climbed about a percentage point, 4.18%. You can see 10-year yields also climbing 1 full percentage point going back to mid-August. Right now, we're looking at 3.74%. Kaylee, what are we looking at today?
Well, we're going to see whether or not we get any more substantial bond moves, because we are going to get some economic data. It is not the most paid attention to, but we will be getting the preliminary read for September U.S. PMIs. What we're looking for is contraction territory still when it comes to that services and composite metric. Services, the expected read 45.5, and remember 50 is what indicates expansion or contraction territory. The manufacturing still expected to be in expansion territory, but a little bit lower at 51. So it really just speaks to the kind of softening we are seeing in certain areas of the economy as we are seeing policy tightening. And on the subject of policy tightening, we will hear from the tightener himself, Jerome Powell. He'll be speaking at 2 p.m. Eastern today at a Fed Listens event. I wonder if his message is just going to be, do you guys get me now? Are we all on the same page? Because I said it at Jackson Hole and I said it again on Wednesday. And finally, it seems like the market is coming around to how aggressive the Fed is actually thinking at this point. So it'll be interesting to see how much he just repeats some of the same language he has been using for some time now. And if he reiterates that line, it will be enough. And finally, looking ahead past this Friday into the weekend, Sunday going to be critical for Italy as they head to the polls. The Italian election going to be closely watched, not just in Italy, but across Europe, as it looks likely the front runner in this race is the right-wing Giorgia Meloni, of course, Brothers of Italy party. She says she is going to be in keeping with Mario Draghi's policy on the fiscal front, but given that she does have a history of being somewhat of a Eurosceptic, there is a lot of question as to what her actual policy will translate to if she does indeed win the election, and that is going to be something very closely watched by these markets. We'll have coverage of that, of course, here on Bloomberg, Lisa.
Yeah, regime change pretty much across the board. Kaylee, thank you so much. Regime change leading many people to wonder, are things starting to break? Steve Sosnick joining us now, chief strategist at Interactive Brokers. Are you starting to see things breaking?
Good morning, Lisa. I wouldn't say breaking. My point was going to be exactly the one that Kaylee just made, which is people are coming around to realize that the Fed is, stop looking for the Fed to be your friend. Stop looking for Powell to say something conciliatory. He's not. And this is, I think, a big splash of cold water in the face of the market. And, we're back down sort of at the levels that were freaking people out in June. We've done basically a full round trip over the past 2 Fed meetings, up then down. And this was all because of the way market interpreted Fed's rhetoric. The big problem to me, though, is, when you have the market unable to price relatively safe assets like 2-year securities, what's safer than 2-year treasuries in theory? But if you can't figure out a way to price 2-year treasuries, it makes it almost impossible to come up with a way to price other risk assets like stocks and things that are even riskier.
Well, Steve, let's talk stocks. I mean, and I hate to talk seasonals, but the world is cyclical, and equities have historically performed rather well in the fourth quarter. I mean, and we're also going into a midterm year, right? So they've performed pretty well on the 12 months following a midterm. I'm curious, what are your thoughts on the impact of seasonal factors as we head into the fourth quarter for U.S. equities?
Well, my first real job, basically, came out of the Salomon Brothers trading class just in time for the 1987 market crash. So I'm very much, a person who keeps seasonals in mind. The seasonal that I'm keeping in mind, unfortunately, is the last time that the Fed raised rates and had, was trying to shrink its balance sheet. I don't even know if they called it QT at the time. QT at the time was fourth quarter 18, and that was a seasonal problem because the market sort of came to this nasty slamming of the brakes. I don't want to go quite so far as to say we're going to see that again, but the 15 or so % decline since we've seen in the last few weeks has that smell to it. And so the problem with seasonals are they work until they don't. But I do think there's a bit of psychology that goes on, as people sort of realize, oh, it's the end of the year, my performance is good, my performance stinks, I gotta, I want to lock in whatever it is. And I think that mentality tends to pervade now as well.
Well, aside from seasonals and psychology, if you look at actual fundamentals and the kind of multiple you can put on stocks, Goldman Sachs, their argument being basically it's about 15 is what's appropriate when you look at forward earnings, a forward multiple, given the kind of rates pressure they expect to see, where they expect the Fed to go. On the price side, on the earnings side, you also have the Fed trying to fight inflation, demand possibly deteriorating in this economy. That can hit corporates on the earnings side as well. What kind of valuation do you think we're going to end up with for the equity market as a whole?
Well, that's, we're very much in flux now. I do tend to think that the lower valuation, when I saw the 15 comment, I was not really, that's basically the number I've been sort of putting in my head. We've got an interesting problem. We don't know what earnings are going to do yet. We're going to find out over the coming weeks. They have to be slowing. The dollar has to be a huge headwind for the big multinationals that make up the major indices. And also remember, most of your money that's made and lost in the stock market is through multiple expansion. And so that's really just, that's animal spirits to a certain extent, if nothing else. And, to get back to Lisa's original point, the animal spirits feel crappy this morning and have all week.
Steve Sosnick, the animal spirits feel crappy. That's the technical analysis. Interactive Brokers, thank you so much for being with us. It's true. Damien, right now, things feel kind of crappy, and you see that just money going into cash.
Yeah, no, I mean, the whole pyramid is collapsing now, as they say. No. I mean, look, the whole thing for me is the Fed put really dead? Lisa, I'm not convinced there. I think the Fed blinks at some point here when things get pretty painful.
Really?
Yeah, I do.
Okay, so what does it mean to get pretty painful? I mean, this is actually something that I've been reading notes about.
That's what we want to ask our experts, Lisa.
Oh,
no, I'm
okay.
kidding. No, pretty painful means I imagine we're going to see it in the payrolls first and foremost. I got to believe that's going to be the print that's going to move the needle.
Well, and I wonder, Kaylee, how much this just has to do with how quickly unemployment rises, which is a really uncomfortable thing, not only heading into midterms, but just in general. No one wants to see anyone lose their jobs.
Right.
And if that's what's going to cause the Fed to back away from the rate hiking, it's uncomfortable.
It is. We thought the politics of inflation were difficult. The politics of hurting the economy and the jobs market by fighting inflation are also incredibly challenging. And that is what we're facing going into the midterms and what a Fed that is becoming increasingly politicized is dealing with as they set policy now.
It's a soggy morning ahead of the open. About 2 hours and 15 minutes to go here. Actually, 3 hours and 15 minutes. I'm looking right now. The S&P down 0.8%, 0.9%, call it. Euro 97 handle versus the dollar. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Liz Truss's government has come out with the most radical set of tax cuts since 1988. Both workers and companies will see their taxes reduced. Chancellor of the Exchequer, Kwasi Kwarteng, also eased the stamp duty on home purchases, and that's likely to help home builders and 200,000 buyers a year. And he lifted the cap on bankers' bonuses. In Ukraine, voting starts today in 4 Russian-occupied territories on whether to join Russia. Ukraine and its allies have blasted the votes as shams. U.S. Secretary of State Antony Blinken said, quote, "We will not allow President Putin to get away with it." Hong Kong is making its biggest move yet into the push to end its pandemic isolation. The city is scrapping hotel quarantine for inbound travelers starting next week. In the 3 days after they get to Hong Kong, travelers will face restrictions on their movements, among them not going to bars and eating at restaurants. Meanwhile, Singapore has overtaken Hong Kong to become Asia's top financial center. That's according to the Global Financial Centers Index. Hong Kong's COVID curbs have hurt, while Singapore has been attracting a number of high-profile events. New York and London have the first 2 spots in the rankings, followed by Singapore, Hong Kong, and San Francisco. And Boeing has agreed to pay $200 million to settle the SEC investigation into 737 MAX safety issues. Former CEO Dennis Muhlenberg will pay $1 million as part of the agreement. Regulators say Boeing and Muhlenberg failed to disclose problems with the 737 MAX, which was involved in 2 fatal crashes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Its call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
Next year's planned increase in corporation tax will be cancelled. The corporation tax rate will not rise to 25%. It will remain at 19%, and we will have the lowest rate of corporation tax in the G20. This will plough almost £19 billion a year back into the economy.
Some pretty shocking policy changes from Kwasi Kwarteng, UK Chancellor of the Exchequer, as the UK outlines how they are going to cut taxes, the most going back to 1973, also deal with some of the banker bonuses by scrapping them, and raising a lot of questions about how this is going to play in the markets. It is playing with a pound that is falling absolutely out of bed, new post-1985 weakness, as people take a look at the prospects of foreign investors financing this nation. It comes as there's just general wholesale flood into the dollar. The euro also weaker versus the dollar, 97.68, just shocking at a time when some people are calling for it to go to 95 or even 90, depending on how bad the winter is. You're seeing the risk-off tone permeate through the end of the week. S&P down 0.8%, 37.40, and the 10-year yield, I just can't get over this, 3.74% right now. It has risen from 2.5% at the beginning of August and from 1.6% at the beginning of the year. It has more than doubled at a time when people are wondering what is going to stop it from going even further. We have to talk about the United Kingdom, and Lizzie Burden has been covering all of this. She's at Abington Green for us here at Bloomberg. This is a package that is causing a complete reset in UK assets. It's also creating a reset in some of the social landscape of this nation. Lizzie, what sticks out to you in this vast plan that was put out there by Liz Truss's administration?
Well, do you know what's the truth? A lot of our viewers in the UK just got a whole lot richer. You've got Kwasi Kwarteng scrapping the 45% top rate of income tax. He's scrapped the caps on bankers' bonuses. It's £45 billion worth of tax cuts. If you earn more than £1 million a year in the UK, you're getting a £55,000 tax cut next year, which is twice what a typical earner earns in a year. That's according to the Resolution Foundation. And he's doing it while he's cutting benefits for people who aren't doing enough to find a job in the middle of a cost of living crisis, all in the name of growth, which is a huge gamble, as you say. Politically, Liz Truss says she doesn't mind being unpopular, but she's got to be popular by the election in 2024, and it's an economic gamble as well. You've talked about the tanking bonds, tanking pound. We spoke to Martin Wheel, the former Bank of England policymaker, yesterday. I have to say that he is one of the most known as one of the most level-headed Bank of England Monetary Policy Committee alumni, and he said it's all going to end in tears. Take a listen to what he said.
We've had other previous experiences where chancellors have gone for growth. The most famous examples were the dash for growth in the 1960s and then the Barber boom in the 1970s, and they both ended in tears. And I must say I expect the same sort of thing will happen with Kwarteng's policy, that there'll probably be, although I wouldn't like to say when, there'll probably be a clear run on the pound, and then the Bank of England will be forced to put up interest rates to stabilise the exchange rate, much as we had in 1976.
So you heard from Martin Wheel, former Bank of England policymaker, there expressing his concerns about what this is going to do in markets. But we've just heard from Kwasi Kwarteng. He says that markets are going to do what they do. So he's going to crack on with the job regardless.
It's amazing to me that he can just say, yeah, it is what it is when you're seeing your currency drop to the weakest levels since 1985, Lizzie. And on this fiscal question, it creates a huge issue for monetary policymakers. The Bank of England just hiked 50 basis points yesterday. The market is now pricing an 80% chance of them going 100 basis points, double that, in November. How do Andrew Bailey and co. respond to policy like this on the fiscal side?
Well, what we heard from the Monetary Policy Committee yesterday was that they were leaving the door open to future hikes. They said that they would assess the impact of this mini-budget in their November decision. Goldman had already said before this mini-budget that they saw 75 basis points in November and December. I reckon you'll see a lot of economists changing their calls today. There was such a big vote split on the committee that it wouldn't have taken a lot of movement to get a bigger hike down the line. And crucially, if you look at the guidance that came out alongside the decision, they said that yes, they're prepared to respond forcefully if inflationary pressures persist. They'd already said that, but now they're saying that they're looking out for inflationary pressures, including from stronger demand. So a bit of a side eye at the Treasury, anticipating the inflationary impact of this mini budget.
Lizzie, how are corporates and households really reacting to this? I mean, are they a fan of Liz Truss's plan? I mean, do they believe that the BOE is going too far? I mean, I'm just curious to hear your thoughts here.
Well, you could ask the same of the mini-budget, and we're going to have to see. Truss's hope is that the energy bailouts for consumers and businesses are going to win the hearts of the voters on that side, whilst also introducing all of these measures that will hopefully boost the City of London post-Brexit and mean that the bankers come flooding back. But the Bank of England is going to have to deal with the blowback if this package overheats the economy.
Lizzie Burden of Bloomberg, thank you so much for this. And you'll be joining us again later in the show. I appreciate that. Damien, to your point, the social response really is fascinating. Torsten Bell, who's the CEO over at Resolution Foundation, put out this tweet that I thought was fascinating. Any of you earn £1 million, you're getting a 55,000 pound tax cut next year, twice what a typical earner brings home a year. You know very well from your sector the social pressures that can rise in a circumstance like this. I mean, how much are people looking at the UK increasing like an emerging market currency when you take a look at the pound?
I mean, it's exactly right. When I look at the UK now, I'm thinking Chile. I'm thinking the social unrest we're seeing in other places on the planet. I mean, maybe not to that extent, but certainly, you know, the path is there. You know, that populist pivot that we saw throughout Latin America that's still ongoing is really now reaching Europe's shores, and it's reaching the UK in my mind.
Well, how much pushback, and Damien, we've been looking at a bunch of rate hikes from a lot of developing markets, and particularly front-loading ahead of the Fed. How much pushback is there socially at this point to some of those moves?
Well, you know, it's really quite interesting, and you're bringing up a great point. We saw a host of central banks move on the heels of the Fed just this week, but the one that really catches my eye was Brazil. Brazil was way ahead of the curve in terms of hiking rates ahead of the Fed, and look at the reaction. I mean, in terms of the Brazilian real dollar cross rate, it's really not gone anywhere. In fact, the real is the best performing currency in the world this year, and there it goes.
Honestly, this has been the issue. Rich Clarida, former vice chair of the Fed, saying they are watching the rest of the world, not the U.S., for something breaking. Coming up, we'll talk about that with Derek Maher, head of research for the Americas and head of FX strategy at HSBC Securities. As you take a look, the S&P deepening some of those losses ahead of the open, down now about 1.1%. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Today we have Kaylee Lyons and Damian Sassower with us on a soggy finish to a very difficult week, a reset as we take a look at what's happening with the expectations for a Federal Reserve. What you're seeing in the markets is a pretty dire response. This week alone, S&P futures are poised for a more than 4% loss. Just giving you some perspective, the S&P is down more than 13%, or will be so far since the middle of August, just based on some of the retracement. The NASDAQ down, poised for a 4.3% loss on the week. And you can see Russell also following in with this. This all has to do with yields. We've been talking about that. John's been talking about how the poison is at the front end, very much so, but it's also generally about what's going on with yields broadly, not just at the front end. And you can see it's in the U.S., right? And you are seeing intraday, the yields continue to climb with a 30-year yield now, 3.67%, 10-year yields, 3.8%. But the real issue is the United Kingdom. We are looking at a British market that is falling out of bed on some of the biggest tax cuts being proposed going back to 1973 at a time of rapid inflation and a potential now increasingly priced into the market for a 100 basis point rate hike at the next meeting. Kaylee, this really highlights some of the pain.
It does highlight the pain. And the question is, if you have that kind of fiscal policy, what on earth can monetary policy makers do to stem the bleeding? Is even a 100 basis point rate hike from the Bank of England enough to support the British pound?
And that's the reason why you're seeing 5-year yields climb 46 basis points on the day to 4%, and 10-year yields to 3.75%, 26 basis points on the day, which brings us to the currency. And the pound has been just absolutely hammered. And we've been talking about this, and Damien, you were saying it's trading like an emerging market currency. Well, here you go. This is the British pound going back to 1985. It climbed at one point up to almost 2 per the dollar, and now we're talking parity. We're talking 111, we're talking 112, but we're talking, there isn't necessarily a sense of what's going to be happening, Damien, and that's, I think, what people are really getting concerned about.
Yeah, well, King Dollar has been a thorn in the side of all international creditors, not just pound investors as well. So, look, I mean, I think what's interesting yesterday is that move in gilts really blew out to the rest of the world if you look at the fixed income curves in the U.S., in Europe, abroad. And so my question is really, is there more to come?
All right. Well, Kaylee, maybe we can get some answers at that.
Well, we can at the very least try to. Dara Mar, head of research Americas and FX strategy at HSBC Securities, is joining us now. We have cable, sub 111, 110.79 right now on the pound versus the U.S. dollar. Is parity realistic?
Yeah, look, who's going to rule out a number when things are moving this quickly? And you look at the fundamentals, you're describing them. Well, look, what I think is interesting here is that the currency market, at least for sterling, has taken on, if you like, the structural view. The UK's external imbalance, the current account plus FDI is like 8% deficit of GDP. And now you've added on the fiscal deficit and concerns on that front, and obviously captured in those gilt yields. And so you have that, the twin deficit story that people always throw barbs at the US dollar on. This is the UK story, because if you're purely on a cyclical angle, you'd be like, hey, this could be good for sterling. It's hawkish for rates, it's bullish for growth, let's buy sterling. But clearly, it's the structural parameters that are absolutely dominant, at least in the UK market. So, yeah, who's going to rule out parity? I mean, our forecast is we get to 108, and I guess then we'll have to reassess. But okay, the one thing I would caution on is there is a tendency when things move to get super excited and say this will go forever. So, we need to be a little bit mindful of that. But for now, sure, the momentum is in that direction.
Well, what's stopping it from going forever, though? Because it doesn't seem like central bankers are going to be the ones to do that, because we've seen the hikes, not just from the BOE, but really central banks across the board. And those hikes are not supportive of the currencies. It is just dollar strength, full stop. What stops that?
Well, I don't think there's a great deal in the way of dollar strength. As you know, we've been dollar bulls for a long time, upwards of a year and a half. One of the curiosities, though, I've noticed in this dollar bull rally is when I've gone to see clients or talked about it, the question I tend to get is it, hey, have we reached the peak? Rather than, can this go another 10% higher? It's kind of like the, the road trip where you're only out of the garage and the kid's already asking, are we there yet? We've had this, are we there yet, in this dollar rally. Now, what is of slight concern for a dollar bull like me is now we're getting the questions, hey, do you think we can go to parity on cable, or how low can we go on euro? And, we're not getting that kind of reticence. And of course, that can be a sign that things are getting a little exhausted. I still think we've got some ways to go on dollar strength because you've got a hawkish Fed, you've got a global economic slowdown, you've got risk aversion. They're the three drivers to our dollar view, and until they change, we won't change.
Dara, and you have a BOJ that's just not going to abandon its pledge to cap yields. I mean, what should we make of dollar yen at 143 here?
Well, look, Japan is a peculiar case, isn't it? Ordinarily, with the risk aversion we're seeing, the yen historically has done okay. What's, of course, killed it this time around is that risk aversion has been accompanied by rising U.S. yields rather than declining U.S. yields. And, as you point out, the BOJ is sticking to its guns on its monetary easing for the next 2 to 3 years, they told us earlier this week. So that divergence is prevalent. So in terms of what we can expect for dollar yen, it might actually boil down to the Ministry of Finance. How ambitious are they in capping dollar yen? And also, I think we'll reach a point where the market will look at the yen and say, hey, if we're in a global recession scenario, if that is mounting, the yen's a pretty cheap safe haven at this point. And, if we set aside monetary policy, historically the yen has done pretty well. And maybe we're exhausted on the dollar. Let's look for some other safe havens. But that doesn't feel particularly, I would say, imminent. So I think, the pressure will be for dollar yen higher with the MOF, I think, trying to introduce two-way traffic periodically.
Dara, it's difficult to read too far into some of the price action yesterday. I'm talking on the fixed income markets, but there are other countries like India and Chile that come to mind that have been intervening in their currency markets to defend. And so my question for you is, can we expect some sort of a coordinated effort here? Is there something like a 1985 Plaza Accord in our future?
That feels a stretch. I mean, because of course the key to the Plaza Accord was the US. And we have the Fed is still battling inflation. You're coming up to midterm elections in the US. Is the Treasury going to get on board with something that potentially adds to US inflation issues by weakening the US dollar? That seems improbable. I suspect the angle I would have thought for a yen intervention and, if you like, the contagion element is simply people in your industry. You're going to keep quizzing central bankers about currencies now. You're going to, Lagarde's going to get asked about the euro. Everyone's going to get asked about sterling. And it's a question of, is this complicating your life in terms of trying to manage inflation and get inflation lower, and what can you do about it? Those kind of questions, I think, are going to be front and center. I don't think the US is going to be part of that narrative. They don't want to be. But it does, of course, raise the specter of currency war, which is now a new fashionable term once again.
Of course, there's a question of how to fight that war, Derek. I mean, we heard from, Kayleigh mentioned earlier that there's now a 50% chance being priced into futures that the Bank of England raises by 100 basis points in November. If they do that, if there's an outsized rate hike, what happens to the currency? Does the pound strengthen, or does it weaken even further because that just inflicts that much more pain on the economy?
I think the pound would soar for at least 2 minutes.
What a projection.
We saw that. Look, we saw that. We had the Swedish with Riksbank earlier this week. They did 100 basis points, and Stocky went absolutely ballistic. And then 20 minutes later, we'd reversed fully, and it was weakening. And now, dollar stock is just powering higher because at the end of the day, these currencies are no longer trading on relative rates. Dollar yen is the exception. Most G10 currencies are trading on risk appetite. Most G10 currencies are trading on the domestic growth outlook. And so long as they both remain challenging, then rate hikes aren't going to rescue you. They'll obviously help in the inflation fight, but from a currency perspective, we're seeing mismatches on euro dollar relative to two-year swap differentials, on cable by some distance, and frankly across most of G10. Now, dollar bears say, well, that's why the dollar is overvalued and it's going to retreat. My perspective is this just demonstrates that the relative rate story is not at the heart of FX anymore. It's about global growth, it's about Fed hawkishness, and it's about risk appetite.
Okay, so how do you then fight a reverse currency war?
You can't. I mean, well, you can fight it, but you can't win it. You know, these are global market forces, and you know, okay, you can argue what can you do? Well, you can try and moderate the impact, and that's what the MOF in Japan, I guess, that's their aspiration. That might be their measure of success. Is, you know, okay, we can turn dollar yen around on a sustainable basis. We're fighting pretty profound fundamentals, but can we at least introduce two-way traffic? Not allow this to become a self-fulfilling spiral downwards for the yen. And I think that's maybe what other currency, or central banks, I should say, will try to do with the currencies. They'll introduce verbal rhetoric. They'll talk about how the exchange rate is an important consideration when setting interest rates. They'll say we're closely watching all of the things we've heard from the MOF. We are likely to hear from the ECB and the Bank of England and others. But at the end of the day, it comes back to the dollar. And it comes back, as I keep saying, to the Fed, to global growth, and to risk appetite. And until they change, or at least, you know, stop moving in the direction they're moving currently, then I think it's going to be hard to fight the dominant dollar.
Derek Marr of HSBC Securities, thank you so much. You can't fight it. That, Damien, seems to be the tone out here, which is the reason why you're seeing increasing bearishness, not necessarily even emerging markets, but developed market currencies, just anything other than the U.S.
Yeah, Lisa, I mean, it's this pivot from the inflation story to the growth story. It's never been a smooth pivot, and this time is no different.
I mean, honestly, this is hard to see, Kaylee, how this transpires. And you asked the question earlier, where's the stopping point? It doesn't feel like there is one, and certainly the moves that you've been picking out today in the UK market seem to indicate that's the case.
In the UK, when we're looking at 110 on the cable rate. In China, where we're looking at 712 on dollar yuan. I mean, I get the sense in currencies everywhere, just a loss of control on the part of policymakers. The PBOC keeps trying to set stronger reference rates. It's not doing anything. Japan tries to intervene. The yen is still weaker. Central banks in the West are hiking. It is not doing anything to support the currencies. And I know I'm a control freak, but that loss of control makes me feel a little panicky.
I think a lot of people are control freaks right now. How do you reverse a currency war? How can you fight a reverse currency war? You can't. That, to me, might be one of the quotes of the morning as we take a look at markets that are in a world of pain. Coming up, Terry Haynes, founder of Pangea Policy from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The last time the UK saw tax cuts like this, it was 1988, and Margaret Thatcher was Prime Minister. Chancellor of the Exchequer, Kwasi Kwarteng, is cutting taxes on workers' pay and corporations. The goal is to boost the long-term potential of the economy. Kwarteng also cut the stamp tax on property purchases, and he's doing away with the cap on bankers' bonuses. The special master in the Trump documents case has ordered the former president's lawyers to state in a court filing whether they believe the FBI is lying about the papers. In effect, Judge Raymond Dearie is demanding that Donald Trump's lawyers back up his claims that the FBI planted items during the search of his Florida home. Japan is moving to revive its tourist industry in the wake of the pandemic. Prime Minister Fumio Kishida says a slew of COVID border controls will be abolished next month. Individual visitors will be allowed to enter, and Japan will reinstate visa waivers. The cap on daily arrivals will also be ended. Some of Wall Street's biggest banks see oil rebounding in the fourth quarter. JP Morgan Chase is forecasting Brent crude at $101 a barrel the final 3 months of the year. Goldman Sachs is targeting $125. Brent is trading around $90 today. Analysts say low inventories and sustained demand will keep prices elevated despite concerns of a global slowdown. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
what's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
I think we're now at a point where, given the significant rises in interest rates and yields across the yield curve since the beginning of the year, the equity market is now focused much less on inflation and yields than it is on earnings.
Insightful comments from Abby Joseph Cohen, professor at the Columbia Business School, longtime partner at Goldman Sachs, talking about how the focus is shifting, trying to look for some data in the underlying earnings that we're getting in, for example, FedEx. Kaylee, yesterday, it was really just sort of confirming some of the fears that people already had.
Well, of course, we had already heard from them last week about the deteriorating macroeconomic picture hurting demand. So as a result, what FedEx said yesterday is, look, we're going to try to cut costs to the tune of about $2.7 billion. What I thought was interesting, though, Lisa, is they also want to raise prices. They want to raise rates. How does that work in a demand-destructive environment? Does that not just kind of have the opposite of the intended effect? How do you exercise that pricing power in an environment like this one?
And it's a really good point because there's a social aspect here too, and Terry Haynes has been tracking this, which is we're dealing with stagflation. We're dealing with this concern that a lot of companies are going to be dealing with margin pressures, trying to pass it along at the same time that you have interest rates rising and a fiscal landscape that is fraught. Terry Haynes, founder of Pangea Policy, joining us right now. And Terry, we're looking at that in the United Kingdom as a great example, or perhaps a terrible example, of what happens, at least by the reflection of the currency market and the bond markets, in the face of a fiscal policy trying to give more and focus on growth, and a monetary policy going in the opposite direction.
Yeah, I think that's right. I've been writing about this for a while, as you know. For the first time in a generation, we've got a serious divergence between monetary policy and fiscal policy, and there are a lot of reasons for that are in the abstract good ones. The UK wants to stimulate growth. The UK is very interested in making sure that its citizens don't freeze this winter, and let's remember that part of Chancellor Kwarteng's package that was first discussed was energy price caps and the like to help tide people over for this winter. But it's going to be very difficult. But whether it's Truss in the UK, whether it's Biden in the United States, whether it's the European Union, the European Commission, we have this problem across the board. And in the UK, it's a bet that growth overcomes the risks and the problems. And in the United States, it's really kind of the opposite, making sure that what you have is particular policies that have that get filled up and have the ability to be properly funded, whether it's rehoming semiconductors or pushing green policies. But there's it's a whole new world for an awful lot of people that weren't around in the 70s and 80s. That's for sure.
If we could continue the conversation on the United States, Terry, obviously the Federal Reserve is hiking rates, trying to fight inflation. At the same time, you have policymakers in Washington like Elizabeth Warren saying, I'm worried they're doing too much because they are going to raise the unemployment rate. They're going to hurt the American consumer. How do the politics of inflation, which have been difficult for the Democrats to this point, match up against the politics of hurting the economy to fight inflation? Which one is worse politically as we get closer to the midterms?
Well, what you've got is a situation where President Biden and the Democrats very much wanted the new Fed. Let's remember, 5 out of these 7 governors had to wait for 6 months to be renominated and reconfirmed, and that tracked the time in which inflation really started to dig in and become entrenched. But it's bad timing for Democrats, certainly. But Democrats really wanted a much more dovish Fed, and what happened is I think that the Fed was the incoming Fed was very good at keeping its cards close to the vest. But once they got confirmed, then they decided it was time to do their jobs that Congress gave them. The first mandate here in the so-called dual mandate is attacking inflation, and that's exactly what the Fed is doing. Fiscal policymakers are now complaining, in essence, that they no longer have the free hand that they had before, and that's true enough. But it's going to require the fiscal policymakers to start thinking creatively, and again, for the first time in a generation, and not simply continuing to throw money at things and call problems solved.
Terry, I know these are rough estimates heading into the November midterms, but there's a 40% probability of an all-Republican, 40% probability of sort of a split, and 20% that there's an all-Democratic Congress. What's the best outcome for asset prices?
Damien, to be perfectly clear, those are my prognostications, not yours. So if they're wrong, then the blame's mine. Generally speaking, what you're going to end up with is that you're going to end up with very little changing in Washington in a real sense. If it's 40% Republicans, those are very tiny majorities, and they run up against the Democratic president. If there's a split Congress, then you get very little done domestically. And even if there's a tiny Democratic Congress, as you've just seen, all Democratic Congress, as you've just seen over the last 2 years, it's very difficult for those folks to figure out between the progressive and the centrist Democratic coalitions exactly what their priorities are and exactly what they're willing to do. So, net, my experience has been that, sort of confused do-nothing Congresses domestically generally are not bad for asset prices. And I should also mention that I think, regardless of outcome, unanimity on foreign policy, whether it be Russia, Ukraine, or China, or anything else, continues as well.
Terry Haynes of Pangea Policy, thank you so much. Damien, the mood right now, just to give you a snapshot from Twitter. Guy Labas over at Janney, basically, stuff's breaking, more stuff's breaking. And Paul McNamara, who I know you probably are familiar with, emerging markets veteran over at GAM Limited, put out this GIF that I can't really quote on air because I'll be fined, but he said, mood, everything is bleep, and also something is on fire. But that seems to be the mood that you could see pretty steadily across Twitter.
Yeah, no, for me, it's going to be about the plumbing, right? As something breaking, our market's clearing, our credit market's clearing. I mean, spreads haven't really gone yet, Lisa. Yeah. We all know this. We've been talking about this a while. I'm going to be hyper-focused on spreads in the short end in both in IG and high-yield credit.
Yeah, and a lot of people are looking at that just to talk about things breaking, and that's not where you're seeing things break. Kayla, you were pointing out 5-year gilt yields, and it looks as if they have risen almost half a percentage point in one day, which looks like it may be the most going back to at least 1991. If you just take a look at the pace of moves, the pace of an exodus from the bond market in the United Kingdom.
It's truly alarming. I mean, I almost don't believe I'm looking looking at an intraday chart, when I am looking at the moves we are seeing in the gilt market, in the sovereign market. But to Damien's point on credit, you really aren't seeing that blowout. You still have high yield spreads sub 500 basis points. We've heard from Bob Michael over at JP Morgan, for example, saying realistically that should be something like 750. I'm wondering what all other asset classes seem to be getting in terms of messaging that hasn't shown up in credit yet. And if it's not showing up in credit, is there anything going on right now that is going to cause the Federal Reserve to blink?
And this really goes to a point that Bank of America's Michael Hartnett put out overnight, where he was talking about some of the recent flows in the great bond market, the third great bond bear market, talking about how there are some potential threats to liquidation events. But this quote stands out to me. True capitulation is when investors sell what they love and what they own. Right now, you see the S&P futures deepening some of those losses down nearly 1.4%. The euro continuing to trade at a 97 handle versus the dollar. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
every central bank is competing with every other to bring inflation down quickly.
There's a lot of confusion. Investors are not sure how this is going to play out.
We're finding real opportunities. There has been carnage in this market.
It's all about the rate of change, and I think that's what really central banks would react to.
The government's really taking a gamble here that the policies that it's implementing are going to do something to boost growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A deepening sense of doom. Welcome back. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. I hear that Tom Keene and Jonathan Farrow have stopped watching Ted Lasso, and now John has convinced Tom to watch reruns of Spurs instead. Just his research. We are very lucky today. We have Kayleigh Lyons and Damian Sassower in the house on a day when markets very much front and focus. Kayleigh, things are deteriorating rapidly after already resetting through the week, through the month.
You call it deteriorating, Lisa. Some people might call it breaking. We are seeing a real breakdown, specifically in the UK today, with the cable rate now at a 110 handle after fiscal policy announcements from the government, the new government in the UK, and the 5-year gilt yield on the day is up 47 basis points. These are just unbelievable market moves, Lisa, and it's really everywhere you look.
So breaking, that's actually a really important word because so many people have come out, Kayleigh, and said, until things break, the Federal Reserve is not going to blink. They are not going to pause. They may not even slow. Does this count toward that breaking?
I wonder if it matters what thing it is that is breaking. If it's the labor market that looks like it's breaking, which it does not look like yet, even if we have seen some softening. If it is the credit market, which looks like it's breaking, which to this point, it doesn't really yet. It's a lot concentrated in foreign exchange and in the government bond markets. And I wonder if the Federal Reserve is looking at this saying, okay, well, this is kind of what we thought would happen when you understood how much we're really going to tighten.
And Damian, this goes to the point that you were making. Credit is not breaking. You're not seeing credit spreads blow out. You still are seeing people say it's actually a great time to buy because you're getting yield. Why has credit been so resilient?
Well, that's a good question. I mean, look, the fact of the matter is they're relatively liquid when you look at it relative to FX and treasuries, right? So it doesn't take a whole hell of a lot to move the needle there. I imagine after some of the price action we've seen over the last few days, you're going to start to see things slide. The question is, how far do they slide?
Wait, this is a really important point, Damian. You're saying that perhaps it's just that things are not trading enough to really get a true sense, that there isn't necessarily the forced sales, that people have been able to avoid triggers. What will be the trigger if a bear market, unlike anything we've seen in modern history, isn't enough to do it?
Well, I mean, look, I mean, it's far be it for me to judge, but for me, it's always going to be about the plumbing. You know, I started my career in money markets at Goldman Sachs. So, you know, I mean, I'm talking tri-party repo. I'm looking at, you know, specials versus GC spreads. I mean, those are the kind of things that you have to look at for indicators of whether or not the plumbing is working properly. Right now, it seems to be. But, you know, again, you know, as you rightly point out, I mean, if we see forced selling from retail investors and institutions alike, you know, the credit markets could start to snap here.
Right now, what we're seeing is very much pain across the board, particularly when it comes to the United Kingdom market. Just taking a look at futures right now, they are down. They are continuing to decline throughout the morning, down 1.4% on the S&P. NASDAQ deteriorating even more, 1.5%. But really, what we're looking at is in the United Kingdom, 5-year yields climbing by nearly 50 basis points, by nearly half a percentage point, up nearly 4.1%. The pound, absolutely. How much are we going to hear about parity at a time when people are looking at the biggest tax cuts in that nation going back to 1974? And crude off, Kayleigh, as we take a look, down 3%, taking a look, that's Brent, to 87.73 as people look toward deteriorating backdrop, people not spending as much, growth slowing. It's really bleak.
It is a bleak morning. I mean, it's red everywhere you look. And to your point on parity on the cable rate, what stops these moves in foreign exchange? What can stop the strength of the U.S. dollar, at least at this point? The answer seems to be nothing yet. Now, as for what is ahead on the day today in terms of what we should be looking at events-wise, 9:45 a.m., we are going to get a little bit of economic data here in the U.S. in the form of preliminary September PMIs. What we're likely going to see is contraction territory again on the services metric as well as the composite. Softening in the data we are seeing, which of course is in part intended as we see the Federal Reserve tightening policy. In terms of the Federal Reserve, we will be hearing from the man himself, Jerome Powell, for the second time this week. He'll be speaking at 2 p.m. Eastern time at a Fed's Listen event. Is he just going to repeat himself? Like he repeated much of what he said in Jackson Hole at the press conference this week. His message is we are going to keep going, we are going to fight inflation, and ultimately it will be enough. Is he now happy that the market seems to be more on board with his and his team's messaging on that front? Then finally, looking ahead through this weekend, Sunday is a day to watch in Italy with the election. It is likely going to be Giorgia Meloni, the far-right candidate, who ultimately wins that along with her far-right coalition. She has said she is going to stick with the fiscal policy of Mario Draghi, but there remains some serious questions around what actually governance translation will look like in terms of how it compares to what she has been saying rhetoric-wise. That is a lot of concern around the Eurozone, considering she is somewhat of a Euro skeptic. So definitely something that the markets are going to be watching in the days ahead, Lisa.
Kaylee, thank you so much. It is a morning of fear. It is also a morning of revision, and it has been a week of revision for Wall Street strategists across the board, with Goldman Sachs slashing its year-end target for the S&P 500 to 3,600. It previously had been 4,300, a pretty big revision. Julian Manuel, equity derivatives and quantitative strategist at Evercore ISI, has been out ahead of some of what we have been seeing. Julian, have you reset some of your expectations based on the Fed meeting this week?
Oh, we certainly have. Look, we're calling for earnings next year basically to be flat year on year with this year, and frankly, we were below consensus and continue to be below consensus for 2022 as well. And obviously, we slashed our price target, and it's one of these years that now, actually, Wednesday has ushered in the emotional phase of this bear market, which, frankly, every bear market does tend to have an emotional phase, simply because when you look at what the Fed chair said and the projections, and importantly, it's that unemployment number projected to be 4.4% next year, where the rate of change, there's never not been a recession following hard upon that kind of change. And all of that has caused the emotion.